the Fed is at the risk of losing confidence. They opened the door for the conversation of rate reductions too soon.
There's more inertia to inflation in a post-COVID economy than the Fed's giving credit for.
Rate cuts are being pushed back for the right reasons, but they're still coming.
The challenge has been everyone's waiting for certainty. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like.
The Fed would really like a scrap of certainty about what they're going to do later this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance on tour. Number 1 Bryant Park, the home of Bank of America here in New York City. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Bramo accidentally going to 731 Lexington Avenue this morning. Just about making it in time for our special program.
That's
Good job, Brian Moynihan doesn't join for another 60 minutes, because if he was...
Really?
Bramo coming through the door late, trying to work out where she is.
I had to go to get some things. I was prepared. I was there early, but I will tell you, it is great to be here. And I've got to say, do you want to trade?
This is going to fill out. This is going to fill out through the next 2-3 hours or so.
Okay.
We've got a fantastic lineup for you. Brian Moynihan's going to join us in about 60 minutes from now. We'll catch up with Mark Cabana in just a moment too. We need to start with the price action this morning, and I think we have to begin with dollar yen. Someone tell dollar yen. Something truly historic just happened overnight, something we haven't seen since 2007. The Japanese yen is weaker over the last 5 or 6 sessions, even though we have just seen the first interest rate hike in 17 years.
So 2 things. Number 1, this is well telegraphed, right? So on one hand, people were expecting this, but some of the rhetoric out of the central bank wasn't exactly hawkish. They basically were indicating that they weren't prepared to hike again. So that's probably why this currency pair is basically, I don't know, dead in the water. I mean, I don't understand this at a certain point. This is what everybody was waiting for. And I guess buy the rumor, sell the news.
Well, I think you nailed it earlier on in the week. There is a big difference between the end of negative interest rates and the end of easy money. This is not the end of easy money in Japan. I think Governor Ueda coming out of his way to say they need to keep things accommodative. So yes, the end of negative rates in Japan, but the end of easy money, not quite yet. We've got to work out what this cycle is going to look like. I remember you and I were talking about this. The first time the Bank of England hiked interest rates, when was that? The end of 2021? And I got on the phone and I said to you, what matters here is not the first move, it's how far they ultimately go. How far do you think the BOJ is actually going to go after this move overnight?
I think to where they are right now. I mean, maybe eventually they'll go higher, but right now, from all of the commentary that I've been hearing, there is no indication there is going to be any further rate hikes, just simply because they don't have to. I am curious, when you take a step back, this is the end of the negative rate experiment, right? Because this was the last central bank to remove that negative rate policy. When we write the book, will it be considered stimulative or actually somewhat suppressive of growth? I actually wonder what the history books will say.
I think a lot of books are going to be written on that, and they'll be inconclusive for a long, long time. I think whatever you thought during the negative era is what you're going to think in the subsequent 20, 30 years. We'll be arguing about this forever. And let's hope we never get in the situation again where we need to have a conversation about negative interest rates. Big changes in the last 12 months. The Federal Reserve has gone from 0 to 550. We've seen a similar move at the ECB as well. And here we are. Let's just start with this. The Global Fund Manager Survey from Bank of America is out this morning. We'll be talking about some of the highlights through today. Global growth expectations, 2-year high. Risk appetite, the highest since November 2021. EPS optimism, the highest in 2 years. That is with interest rates with a 5 handle in America. Does that look restrictive to you based on what we're seeing in the FMS survey coming out of B of A this morning?
Bonds and stocks are operating on 2 time frames right now. Bonds are considering whether Fed funds rates are a certain level, and they're looking at potentially the inflation rate. Stocks are looking at what's going on in the tech revolution. They're looking at productivity boom. They're talking about all these other things. At what point do stocks wake up to bonds? And we haven't crossed that threshold yet. And that's what it seems like. Are we going to test that threshold at which stocks start waking up to the prospect of higher for longer?
How about this, when we spend more time talking about Jay and less about Jensen? Maybe that's going to be the turn. Equity futures right now on the S&P 500, negative by 0.2%. We had a bounce back in yesterday's session following 3 days of losses. Equities doing okay. In the bond market, yields still very high and close to the highs of the year so far. 431.83. We've been grinding higher over the last 5 or 6 sessions. In the FX market, the euro 108.41. That currency pair negative by about 1/3%. Just a bit of dollar strength through G10, Lisa, yesterday and again today.
Which raises this question: how much emphasis emphasis is there going to be tomorrow on Jay Powell and deciding whether or not the dollar is going to keep rallying? At this point, over to you, Jay. Let's see what you got. Is that really going to be the deciding factor? The BOJ is off the table. It's all about the Fed.
Fed decision just around the corner. Coming up through the next 60 minutes or so, we'll catch up with Mark Abramowicz, the head of U.S. rate strategy, as investors continue pushing back bets on the Fed's first cut. Liz Everett-Chrisberg of the Bank of America Institute on the state of the U.S. consumer, and Marcy McGregor of Maryland Bank of America Private Bank on the equity rally ahead of tomorrow's Fed decision. We begin with our top story. The FOMC meeting getting underway today as traders push back bets on the Fed's first cut beyond June. Mark Abramowicz of BofA Global Research is looking for discussions on the balance sheet, writing this: the Fed needs to prioritize how and when to slow QT, given the reduction of excess liquidity in the system. Slowing QT is Fed priority number one. Mark, I'm pleased to say, kicks off our show this morning. Mark, good morning.
Good morning.
Good to
Thanks
see
so
you.
much for being here.
Thank you for having us.
Great to have you.
Looking forward to the programme for the next 3 hours or so. Let's kick it off with the balance sheet.
Sure.
What are the considerations that go into making a decision like the one that they have to confront through the next 24 hours?
Sure. So we do think that the balance sheet's going to be a really important point of discussion at this meeting. And really the Fed is going to have to answer the question, how far and how much excess liquidity do they want to remove from the system? And how comfortable are they pulling that cash out of a banking system that appears to really be wanting to hold very elevated amount of reserve levels and cash levels?
Taking a step back, we're talking about a $7.5 trillion balance sheet that has shrunk from about $9 trillion. And people aren't really talking about this because we don't really understand what effect it's actually had. What effect has that balance sheet shrinking by $1.5 trillion, has that had on a market that seems pretty intent on rallying?
Certainly. So the clearest thing that excess liquidity reduction has done is it's really pulled cash out of money market mutual funds, or at least it's pulled the excess cash that those funds are investing with the Fed. And that has caused money market rates to rise to some extent. Treasury bills are not nearly as rich as they were, let's say, a year or so ago. But that's really the only impact that it's had. In terms of a broader marketplace, it hasn't done much at all. And so the Fed is going to have to ask, well, how far do they want to keep pushing the balance sheet reduction, and how much do they want to risk, again, pulling some of that excess liquidity out of commercial banks that have been, in our assessment, clearly bidding up to hold that excess?
The fact that it hasn't had as clear and obvious an impact on markets is the reason why a lot of people aren't paying attention to it. To be completely honest, a lot of people's eyes glaze over and they just say, we want to know where the dots are. Do you think that there's too much emphasis on the dots?
Well, okay, so in terms of priority one, as we wrote, that was with regards to the balance sheet discussions. The Fed's real focus is going to be, what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy? Those are the big questions that they have to ask right now. So the market, in our view, is right to focus its attention on the dot plot, keeping the balance sheet secondary, but slowing QT, when they think about all the considerations around the balance sheet, that is indeed the number one priority that they have there. Now, on the dots, the big question is, are they going to show 3 cuts or 2 cuts for their expected 2024 outlook? And that's going to have, we think, a pretty notable rate market response either way, because the market is quite divided on this. You talked about the fund manager survey that Michael Hartnett does. We do our own survey of really rates and FX clients. When we ask them their expectation for the dot plot, 68% say that they think that the Fed will keep 3 cuts for this year, so 75 basis points of total rate cuts this year. Now, that survey closed about a week ago. That has probably shifted a little bit as you look at how much the market is taking out Fed rate cuts for this year. The fact that the June meeting is now right around 50-50 in terms of whether the Fed will go or not. So the responses that we got suggest that maybe the market is closer to 60-40 in terms of investors thinking that they'll show 3 cuts versus 2 cuts. But that's going to be the big question. And the market's going to respond in either direction, we think. If they only show 2 cuts, not the B of A economics base case, but if they only show 2 cuts for this year, so they take out 1 cut, we think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. We think you'll see the dollar rally. And we think you'll probably see risk assets take it on the chin to some extent. And that is because the market's going to be questioning, well, how accommodative is the central bank really going to be? If they show 3 cuts, as they had in December, and as our economists expect that they will, we think that the 2-year will probably rally by 5 basis points, curve will bear steepen, and you'll sort of see dollar weaken and risk on. So it is a bit of a pivotal point, we think, for markets. And I know I've been talking for a while, so feel free to cut me off. But Lisa, you asked before, how long until the equity market catches up with the bond market? And I do wonder to some extent, how long before the bond market actually catches up with the equity market? Because you can look at price action and say, oh, well, monetary policy is just way too easy and rates are too low, and that's why the equity market is doing this. When I talk to our equity market folks who occupy this space as well, what they say is, Mark, we kind of don't care about interest rates. Have you seen the growth profile of these companies? Have you seen how strong the economy is running? Jonathan, you talked about that fund manager survey, right? All these like super strong growth, risk appetite very high. They just don't think that whether or not you have 10s at, let's say, 430 or 10s at 475, maybe even 5%, really disrupts the investment narrative. And that is a real question that the market's going to have to rebalance. And I do wonder if the bond market might have to rebalance to what the equity market's telling us.
We're in your home this morning, so I won't cut you off. You can have as much time as you like. I do want to ask about something you said, though. The equity market will take it on the chin. And then you really laid out as to why the equity market will probably take it on the chin. So it makes me think about bonds all over again. If you think about what's happened this year, January 4.1% on a US 2-year. We've gone from 4.1% to 4.70 this morning. Over the last couple of weeks, we've been in and around that level. And equities have done nothing in the face of that, which just tells me that yields can go even higher. And they can keep going higher until they become a problem. Is that the right way of thinking about this?
I think that if you were to just look at what financial markets are telling you, and if you were the Fed and only looking at financial conditions, I think financial conditions would tell you that monetary policy is not yet sufficiently restrictive. Now, the Fed believes, and Jay Powell says time and time again, monetary policy is set well into restrictive territory. Financial conditions are not telling you that. Also, I can't help but rewind to where we were last summer and fall. And as you know, at that point in time, we saw rates sell off very materially. 10-year rose over 100 basis points, 10-year real rate rising about a similar amount. And risk assets and financial conditions were relatively stable throughout that, right? The equity market didn't really go down that much. Credit spreads didn't really widen that much. And yet the Fed told us that they were very worried about higher term premium, and they felt that higher interest rates were doing the work for them. But when we looked at risk assets, we said, risk assets don't care about this. And risk assets don't care about the rate rise because we thought it was all about better growth expectations. And the market was taking out Fed rate cuts, so that's what was pushing rates higher.
Yep.
And risk assets were generally okay with it. And then the Fed subsequently eased in the face of that, right? And they drove rates lower really over the course of November and December through very dovish rhetoric. And the Treasury Department also did their part, right? They issued less long-dated bonds than we thought. So both the Treasury and the Fed eased financial conditions very substantially. And risk assets kept rallying over that period of time. So I go into this to just make the point that risk assets are telling you that the economy is fine, corporate growth expectations look very, very healthy, and maybe interest rates are really not all that restrictive. That, I think, is the key question that they have to grapple with over, at the meeting the next couple of days. The balance sheet will certainly be a focus. It's secondary to the setting of monetary policy. And then they really do have to ask themselves, well, how restrictive are we? And I do think that that is an open question for them.
Can we wrap it up with a target? 470 right now on a 2-year. What are you guys thinking about now?
So what we're thinking about is, and what we're telling clients, and we've been saying to clients over the last probably month or so, is that they can be patient. Clients can be patient on adding duration, because we do think that rates will continue to rise in the near term here. And that is really due to the fact that growth has been so strong. Again, risk assets are not telling you that financial conditions are particularly restrictive. And as a result of that, we think that investors can probably wait until, let's say, rates are around 450 to really add long positions and be comfortable with that. So, excuse me, we do think that the path of least resistance in near term is probably higher rates. We do have a Q1 10-year forecast of 4.4%, still very comfortable with that. Our end-of-year 10-year forecast is 4.25%, well above consensus. Used to be well above the forwards, not really anymore. And we do think that that's very consistent with just this expected very strong growth backdrop in the U.S. economy, and maybe a reassessment of the Fed in terms of how much they will actually be able to cut this year.
You've given us a ton to think about. It's great to kick off the program with you, Mark.
Yeah, thanks so much for having me, and thanks again for coming in.
Thank you very much, sir. Tesla. Mark Cabana there of Bank of America Global Research. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief with Shanali Basek. Hey, Shanali.
Good morning, John. President Biden and Israeli Prime Minister Benjamin Netanyahu held their first call in more than a month, and it was to try to ease tensions over Israel's war in Gaza. Netanyahu agreed to send a group of advisors to Washington to talk about his planned invasion of Rafah, and Secretary of State Antony Blinken is heading back to the Middle East for his sixth visit since the Gaza war broke out. He's been in Europe and Asia since last week, and now he'll extend his trips with stops in Saudi Arabia and Egypt to push for a ceasefire between Israel and Hamas. And former President Donald Trump is narrowing down his list of potential running mates for November. Bloomberg has learned that Trump has ruled out Vivek Ramaswamy as his vice president. Sources tell us, though, that Trump told the entrepreneur personally he won't be his vice presidential pick, but is considering him for a cabinet position, including as a possible Homeland Security secretary. And the Bank of Japan has ended its era of negative interest rates. The central bank is signaling that easy financial conditions will continue, giving few clues on when to expect further hikes. The central bank is shifting from its negative interest rate policy after saying its 2% inflation target had come into sight, and the move has prompted a slide in the yen past the 150 mark against the dollar. And that's your Bloomberg Brief, John.
Hey, Shanali, thank you. Up next on the program, making the case for Tesla.
My view on Tesla is it's easy right now to get negative. They're going through a white knuckle period. They will gain more share. The leverage will be there. And I believe ultimately numbers, EPS growth will start to come back up.
That conversation coming up next, live from New York City this morning. Good morning.
The Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City this morning. Good morning. For our audience worldwide, live from the home of Bank of America here in New York throughout this morning for the next 2 hours at about 41 minutes or so. Your equity market looks like this on the S&P 500. Futures pulling back ahead of the Fed tomorrow. Equity futures just a little bit softer on the S&P 500. We're down about 0.16%. Yields pulling back very, very close to 2024 highs in the last couple of days. 4.31 on a US 10-year. In the FX market, the dollar stronger against G10 yesterday. Repeated that again today. 108.42 on euro dollar. Under surveillance this morning, making the case for Tesla.
My view on Tesla is it's easy right now to get negative. They're going through a white knuckle period. I mean, China demand's been soft, the margin story, the communication. But look, my view is on the other side of this will be a company on its way 2.5, 3 million units when we look at the next few years. They will gain more share. The leverage will be there. And I believe ultimately numbers, EPS growth will start to come back up.
Here's the latest. Tesla are looking to raise prices on the Model Y and regain investor confidence after becoming one of the worst performing S&P 500 stocks of the year. Bank of America's senior auto analyst John Murphy maintaining a neutral rating with a 12-month price target of 280, citing Tesla's, quote, unique ability to remain agile. John Murphy, I'm pleased to say, joined us now with more. John, great to see you.
Great, thanks for having me.
Let's just start with how difficult this industry is at the moment. Who's got this right? Who saw exactly where this market would be at this time?
You know, I'm doing this for 25 years, and it's always an industry that's difficult to get right. There's lots of ebbs and flows. But I think when you look at this, the one company that has been very good and very agile and sort of foundational has been Toyota. And I think when you look at this 1-6-90 rule that they have, where they say basically for all the precious metals and everything you're putting in the battery in an EV, they can make 6 plug-in hybrids or 90 hybrids. With those 90 hybrids, they save 37 times the CO2 as you do with one EV. So the consumer would be a lot more adopting and is a lot more accepting, I should say, of hybrids. So that really seems like a very good interim solution until we get EVs or hydrogen fuel cells ultimately worked out.
Just to sort of underscore a point that's sort of implicit there, are you saying that electric vehicles, as we know them and as they're being produced, are not the environmentally friendly vehicle that, say, a hybrid even would be?
Well, when you look at well-to-wheel, there's a lot of sort of debate on how environmentally friendly EVs are, and it's probably about a 5-year payback period versus an ICE vehicle, somewhere in the middle in an EV versus a hybrid. But the reality is that EVs work very well for folks that are in large suburban houses that can put a charger in and then have a second car. For the masses and folks that live in cities, they don't work so well right now. So it's a real challenge. So really, ultimately, what you need to do is make a better product for most folks at a better price. And they're just not there right now. And we have major issues with the charging infrastructure.
Do you think that the answer is to allow imports from China at cheaper price points, or do you think that China has its own interest for creating an electric vehicle ecosystem that is different than either environmentally sound or dominating a marketplace that's a surety when it isn't necessarily?
So one of the major complicating factors of looking at this industry is it's so macro, and it has so much to do with the broader economy. If you're Xi and you're sitting there trying to drive your economy, you're pushing the auto industry. It's, your biggest employment base. It's your biggest, sort of position of national pride, industrial manufacturing base. So they have a real position here to drive forward the industry and build their national champions, and they're doing it with EVs because they couldn't ever quite get around on the ICE powertrain. So really, their motivation is to drive their economy forward. It has less to do with the environment and it has more to do with that. And what you've seen from China is 3 years ago, net import-export on vehicles was zero. It was about zero. Last year, it was about 5 million net exports. So they've become a big player on the global stage very quickly. It's really quite amazing.
Do you think this could spell the end of the global auto market? Are we just going to see a bunch of different regions with quasi-state-sponsored national champions operating at different places?
We're kind of already there. And so in some ways.
The future's now.
Right. The Japanese support the Japanese companies. The U.S. supports the U.S. companies. We saved GM, took GM and Chrysler into bankruptcy and out of bankruptcy in the U.S. There's many people that think that Germany supports the G3. South Korea supports Hyundai, Kia. Yeah. When you look at all this, it's a major part of your economy. In the U.S., it's 4% of GDP. It's a larger portion of your employment base. When you get into the secondary market, it's twice that. So if you were trying to drive and support an economy, this is really where you start. And then you get into sort of the political aspects of support from that labor that creates this real circular reference with politicians.
So you've got to help us pick stocks, but I wonder if the government is doing that for us. Is the government doing that for us?
In some ways, some of the intervention, whether it be incentives or regulation, really, are something you have to really consider here, and they drive it for you. Just think about this. The whole industry is limited in the utility and value it can drive for consumers by speed limits. Right. The ultimate function here is to get you from A to B quickly. And because you have a limit, that's called the limit, right? That's a limit on the value you can actually deliver to consumers.
So there's a question between some of the subsidies on electric vehicles and the trend that's shifting toward hybrids. Which is going to win out, and who's best positioned to kind of toggle between that tension?
So usually the market wins out. And when you look at this, the consumer is pushing in the direction of hybrid. And the beauty of not a plug-in hybrid, but a regular hybrid is you improve the fuel economy by at least 50%, and the consumer has no idea that they're driving a different kind of powertrain. It's cost effective. It goes. They operate the way they do right now. They don't have to worry about charging or plugging it in. So I think as we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. In the U.S., we saw EVs drop sequentially to about 7% of the market in January and February of this year. In China and Europe, even the markets that are pushing this heavily, you're starting to see a fade in the rate of increase on penetration. So I think we're going to see a market that gets heads towards hybrids. Toyota's very well positioned. Ford's pretty well positioned. Yeah. GM is playing catch up. The rest of the crew are playing catch up. But Toyota's taking the lead there.
Hey, John, this was fascinating. John Murphy there of Bank of America. It's a conversation we've had on this program before. Every time we have this conversation, I get the green activists starting to email in. Bottom line, it doesn't matter what they think. When you speak to the experts on this matter, they are not that environmentally friendly. They are just not.
Which raises this question of, okay, how much can you actually backpedal on some of the policies and some of the expectations that have been baked into the market?
Live from New York City, it is Federal Reserve Decision Eve. Is that a thing?
No.
It is now. Equity futures on the S&P 500.
It's like day one of the two-day
meeting. Negative by 0.1%. They're not even awake yet.
Okay, well, they will be.
Okay, we're down about 0.2% on the Nasdaq 100. Took us about 30 minutes to take a dig at Chairman Powell. In the bond market, 2-year, 10-year, 30-year. 2-year, what a repricing we've seen through this year from 4.1% at the lows of the year, back through 4.7%, 471. Catching up with Mark Cabana here at Bank of America just moments ago, about 30 minutes or so ago, basically saying that we aren't sufficiently restrictive, and that opens the door for yields to go even higher at the long end than where we are right now.
I love what he said, which is maybe stocks aren't listening to bonds, but maybe bonds aren't listening to the stock market. And basically what the stock market is saying is that rates can be substantially higher from here and still allow this economy to keep chugging along, because there is a reason why stock markets are not paying attention to the level of rates where they are.
Yields keep pushing higher. Monday through Friday last week, and then again this week to kick off the week. Monday morning, we were pushing higher, in the afternoon as well. This morning, this Tuesday, we're down about 2 basis points at the front end on a 2-year. On a 10-year at the moment, down about a single basis point at 431. Let's switch up the board and turn to foreign exchange and check out euro dollar and a bit of dollar yen if we can as well. Dollar yen. Someone wake up dollar yen. It's amazing. 150.54. This is another day of yen weakness in the face of the first interest rate hike going all the way back to 2007. And I think we should draw the distinction between ending negative interest rates and ending easy money. This was the end of negative interest rates. I'm not so sure the Bank of Japan wants to call it the end of easy money.
Which is the reason why perhaps we're not seeing more of a reaction. Kit Jukes, he has the greatest explanation.
From yesterday?
No, today. This is the latest from Kit Jukes of Societe Generale. The FX market thumbs its nose at the BOJ and history. Essentially, that's what we're looking at right now, is the FX market saying, you think that this is something, you think this is a move? Well, check out the rest of the world. They're so far beyond you that that's nothing.
I love the title of Kit's work yesterday. What did he say? Someone tell the Japanese yen that this is a historic moment.
Exactly, which is the reason why perhaps today he's saying, they're just not.
If you looked at dollar yen this morning, you'd have no idea what happened in Japan overnight. In fact, if you looked at dollar yen over the last week, you'd have no idea there was a BOJ meeting where they're about to hike interest rates.
But wasn't this the goal of the Bank of Japan? To make it a symbolic move and not something that actually tightened any kind of monetary conditions? Because ultimately, they don't want to enter another lost decade of growth or a lost 3 decades of growth. And that really is going to be their priority, regardless of what the rest of the world is doing.
If that was the objective, they've been successful. 150.52 on dollar yen. Let's turn to the US consumer. Liz Everett-Chrisberg and the team at the Bank of America Institute seeing signs that the lower income spending growth is slowing. Their monthly report saying the following. This could partly reflect some loss of momentum at the lower end of the labour market. Higher income spending remains weak, but is stronger at the very top end. Just what is happening in the US with the US consumer? We can ask Liz right now. Liz, good morning to you.
Good morning. Thanks for being here.
Thank you for having us. We appreciate it. This quote from your work, I've read this 3, 4, 5 times now. Can I just share this with you? If you're just waking up, just listen to this. Monthly median value of savings and checking balances are more than 40% higher than 2019 for all income levels. You're looking across 69 million consumer and small business clients. That's not a typo, is it?
No,
40% up?
It's not a typo. And we've been working at the Bank of America Institute for 2 years, looking at and leveraging the bank data to tell us real time what's happening. And this has been the statistic that has shocked me. But it's it's what we're seeing for the last 2 years. Everyone thought we were going to run out of money. The consumer was going to run out of money. And this year, the consumer has been very stable, keeping their checking and their savings deposits 40% higher than they were before the pandemic.
So that's not coming down. That's just remained stable.
It's coming down by 0.1%, but it's been around 40% higher for really the last 6+ months.
How much of a cushion is that for the US economy at a time where we're talking about rising delinquencies, maybe some credit card issues as well? How much of a cushion is that?
I think the cushion isn't necessarily on the savings side. The cushion has been in the labor market, particularly for the lower and the middle income consumer. So last month we saw, what we look at is the actual money coming into the accounts. So the after-tax wages and income getting deposited into the accounts. And we saw for lower income consumers that tick back up of 3.4% last month, which is the highest level it's been in almost a year. So when you see the labor market remaining strong, there isn't as much of the need to draw down onto that savings. Now, you mentioned before, you were talking about the difference between the higher income consumer and the lower income consumer. The big difference there, the higher income consumer is generally also participating in the markets. right? So even though their wage growth has actually been negative for quite some time, they've got the cushion of equity market performance.
Some people would say that sounds great. It sounds like everything is hunky-dory, but there's weakness under the surface, and just wait, hold on 1 second, and it comes in the form of leverage, it comes in the form of credit, and that we've seen credit card outstandings go up so much. We've seen buy now, pay later cushion, particularly younger households and their ability to spend. What do you say to that?
Well, I think, have we seen delinquencies move up? Yes, but not to an area that we're really particularly concerned about. The other thing that we look at is what's the ratio of spending that people are putting on their credit card relative to their debit card? That would be an indication that people don't. Those ratios are really essentially the same. But you talked about buy now, pay later, and buy now, pay later I think is really interesting to consider. When buy now, pay later first came out, it really did boost retail spending for the people who were using it. Really up 40+% relative to non-buy now, pay later users. But what's interesting is what's the population that's really using buy now, pay later? When we looked at our data last month, just under 9% of our customers made a payment to a buy now, pay later. So they had used it. Just under 9%. That number is growing relative to last year, but at half the pace that it was. So is buy now, pay later really going to be the boost if less than 10% of people are using it?
Nothing you're saying right now speaks to recession or weakness. Nothing you're saying right now speaks to anything that's close to a slowdown, a material slowdown in spending. Is there any historic corollary to this moment suddenly turning south really quickly with a labor market that still looks really good and people having that cushion?
We keep looking for that. We keep searching. And we're just not seeing it. Now, what I will say is, if we were talking a year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there, just like the deposit balances. They're stabilized at about 40% higher. Again, if we were having this conversation a year ago, lower income households' deposits were up 200%. So they've come down from that peak. They've spent, the stimulus, but they're stabilizing at that up 40%. Labor income continuing to increase.
Do you think there's space to lever up? Do you think there is space to lever up for the consumer? Because every time we see any signs of that, people start to get worried, like this is it, this is a tipping point. I just wonder, given everything you've said, it just sounds like we have space to do that in this economy.
I think everyone is looking for the consumer to roll over, and the advantage we have at the Institute is we're looking at the data as it's happening, and we're not seeing them roll over yet.
What about the small business clients as well? Is there a difference there?
Small businesses, you would think there might be. Small businesses are actually, again, they've been very resilient. They've been behaving very much like the consumer. I do think that they're softer. They're a little bit softer than they had been, but again, not rolling over. Small business was such an engine of growth through the pandemic and continues to be.
Is it across the board, or are there differences from sector to sector at the moment?
That is a great question, and I need to come back to you on that one.
I appreciate that. We can revisit the topic another time. I'm just trying to figure it out, because when we talk about how restrictive we are, a lot of people might point to large companies that can come to credit markets, issue tons of debt. We've seen all the supply through the start of 2024 taken down quite nicely. I just wonder if small businesses are having the same experience borrowing as their larger cohorts, their larger peers.
I think the small businesses are really behaving very much like the consumer is, and they're doing okay, and they're a great engine of growth. So we continue to love doing business with small business, but yeah, they're doing okay.
So just taking a step back as we reset, as Jay Powell wakes up in Washington, D.C. and prepares for his two-day meeting, what some of the fundamental structural shifts have been in the economy to allow people to have more cash in their balance, in their balances. And I wonder how much the housing market has to do with this. The fact that a lot of people used to save money that they would then put as a down payment to a house. That was the massive purchase. Does the fact that that's no longer as much on the table because there isn't the supply and it is so difficult to get into this market, is that one of the reasons why cash balances maybe are so persistently high when in the past they would be put towards something?
Well, I don't know that that's necessarily true, because I think, yes, you have people who aren't necessarily getting into the housing market right now because rates are what they are. They don't have, but at the same time, if you were in a house, you're not necessarily moving either. And I think if you look at rental prices, we have seen more recently rental prices in terms of what people are actually paying. So not necessarily what is being advertised as going up each month after month. But remember, if you're in a rental apartment, you're in there for the year. The rental prices seem to be okay. Now, are they investing, to your point, in the purchasing house? No, but where are they putting that money that they do have? They're putting it into the market. And remember what we talked about earlier with the highest income Americans.
Which brings us sort of full circle. And this is something that we were talking about in the past couple of weeks, how there's been this structural shift with retail investors accounting for a greater proportion of the overall investing base. How much is that a structural shift that materially changes the business of banking in some ways? Because all of a sudden, people have money, and instead of putting it into a house, they're putting it into the market, and they're looking for wealth managers.
Yeah. Well, that's a really good question. It's one we haven't looked at, and frankly, one we probably should consider looking at across the board from what people are doing in their consumer bank versus what they're doing and how they're investing.
So looking forward, what are you watching for to know whether this cycle truly is shifting or rolling over in any material way?
I focus on the labor market. I think the labor market is the driver of spending. The labor market is the driver of how people are able to engage. And if we continue to have a strong labor market, particularly in the lower end, I think we're going to continue to have a consumer that can engage.
Liz, your work is fascinating. Thanks for sharing it with us. Appreciate it.
Thanks for having me.
Liz Everett-Crisberg there of the Bank of America Institute. Just to repeat that line again, because I'm told it's not a typo. Monthly median value of savings and checking balances are more than 40% higher than 2019 for all income levels. Isn't that amazing?
It just defies what everyone has been saying would happen. This was supposed to be the year of the shrinking consumer balance sheet. It isn't happening. That has vast implications. This is the reason why people are looking for signs of weakness in the labor market, which also they're having a hard time finding. So again, it goes back to Mark Cabana's point. He set it up perfectly. Are bonds listening to the stock market? Because if they were, maybe yields should be a bit higher.
We'll return to that theme a little bit later. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. U.S. lawmakers reached a handshake deal to fund the government through September 30th, and that's according to Bloomberg reporting. The agreement comes after the two sides resolved a dispute over the funding of the Department of Homeland Security. Lawmakers will now race to pass the agreement before a midnight deadline on Friday that would lead to a partial government shutdown. And Bitcoin continues its slide from an all-time high after a record daily outflow from the world's biggest ETF for the token. The $25 billion Grayscale Bitcoin Trust posted a $643 million outflow yesterday, the most since the ETF began trading on January 11th. ETFs overall have attracted a net $12 billion, which helped propel Bitcoin to a peak of nearly $74,000. And NVIDIA CEO Jensen Huang has unveiled the company's successor to its AI processor. Speaking at the company's AI conference, Huang unveiled Blackwell, a processor he says is multiple times faster at handling the company's AI models.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
And John, that's your Bloomberg brief.
Shonali, thank you. Appreciate it. Up next on this program, the Fed's #1 priority.
The Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy?
That conversation coming up next, live from New York City. This is Bloomberg. Stocks on the S&P 500 just a little bit softer here, pulling back by something like 0.1%. No drama whatsoever ahead of the Federal Reserve tomorrow. If you were looking for drama, maybe you were looking for Tokyo to do something. They did. If you're just joining us, the BOJ did actually hike interest rates. You'll be curious as to where dollar-yen is off the back of that, so I'll share that currency pair with you right now. 150, 53. Yen weakness. That currency pair breaking out by another 0.9%. It's an interest rate hike. Maybe that's all it is, Bramo, and nothing else.
They talked about weakness potentially from other economies in the region. China. And they're talking about the potential for that really keeping price pressures under control. The bottom line is nobody's really expecting this to be a rate hiking cycle, which is a reason why perhaps people aren't responding. I will say this, over from TD Securities saying that USD JPY is now hostage to the FOMC decision tomorrow. So now, Jay, is important.
This is going to take time. This doesn't just happen overnight. The Bank of Japan's going to just say, yes, OK, we worked on this for 17 years. Let's start hiking interest rates by 200 basis points overnight. This will take time. This is the first move of how many moves?
Well, maybe one.
I wonder. At the moment, it's the end of negative interest rates. We've said this a few times. It is not the end of easy money yet in Japan. It might be the beginning of the end of easy money. Under surveillance this morning, the Fed's #1 priority.
The Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy? Those are the big questions that they have to ask right now. So the market, in our view, is right to focus its attention on the dot plot, keeping the balance sheet secondary, but slowing QT when they think about all the considerations around the balance sheet. That is indeed the #1 priority that they have.
Here's the latest this morning. The Fed rate decision due out at 2 p.m. Eastern tomorrow. The market implied odds of a June rate cut falling below 50%. Ahead of the decision, Bank of America upgrading the outlook for U.S. equities driven by an upgrade to small caps. The head of portfolio strategy, Marcy McGregor, anticipating some choppiness as cross currents emerge, including the Fed adjusting policy, the election and geopolitics. But overall, an upward trend. I'm pleased to say that Marcy joins us now for more. Marcy, good morning to you.
Good morning.
We caught up with Mark Cabana, different side of the business, I know, but he raised an interesting point, and I'd like to discuss it with you. Just how relevant are higher interest rates to this equity market at the moment, given how much we've repriced and how little equities have moved back?
I think interest rates are going to be really important here, especially for the small cap space. We recently upgraded. I think as long as interest rates stay reasonable, there's a lot of reasons small caps can shine. Valuation, historically cheap relative to their large peers. Big picture themes like reshoring, like infrastructure development, all would benefit small caps, but interest rates need to stay at a reasonable level, and that could lead to an extended period of small cap outperformance.
Define reasonable.
You know, our view is that interest rates likely move sideways from here. Obviously, the market's holding its breath a little bit ahead of the Fed tomorrow. I keep talking to clients about what matters to the market and what is just noise. And clearly, one of the two things I think that matters is the Fed. The other, of course, is earnings.
Well, OK, so just sticking with the Fed for a second, because at some point, Jay will be getting out of bed. You probably already have had out of bed, I will say, getting prepared for.
That, aren't you?
Well, I think that probably most people, especially, do you think he gets nervous?
6:50 in New York, I think it's like 4 a.m. in Washington,
okay,
D.C.
It's the same time zone. You know this.
2-3 hours behind us.
All right, moving on. There is this question about what he would say that could potentially make you reassess your thesis in small caps at a time when it just hasn't gotten off the mat. Everyone's been wanting small caps to rally, and it just hasn't been outperforming.
So when I think about what really matters from the Fed, it's going to be how clear is Powell's communication tomorrow. How transparent is he about policy? Clearly, we're going to hear a Fed that is likely on hold. It's going to be talking about a balance of risk, the risk of cutting too soon versus holding policy too tight for too long. I think he's going to try to take this really balanced view is my expectation, but transparency and why, the rationale for why they cut rates when they ultimately do. Are they recalibrating policy? Is it an adjustment? Or are they cutting rates because an economy is slowing? That's not our view. So I think the messaging is almost more important than whether it's June or July or, you know, what the exact timing is.
Well, at the moment, they appear to be pushing back the timing, or at least the market is, because growth is decent. We heard from Neil Dutta of Renmac yesterday. He wrote in nominal GDP. It's pretty solid, which is a reason to like equities, not dislike them. You like the US over international. Why retain that home bias to America right now? Is it the rest of the world just not doing that well?
Well, if you look outside of the U.S., you know, here in the U.S., I think we see so much resiliency in earnings. We're starting to see this rotation under the index level. And I think that's really driven by earnings picking up in other sectors like discretionary, financials, industrials. And I think that's really important here to the U.S. story. But if you look outside of the U.S., you know, you have parts of Europe flirting with recession. You have China has been cautious in terms of their easing and stimulating the economy. I think there's just a more exciting story of resiliency and earnings growth. I think the earnings path may be slow in the U.S., but I think the trend is improving.
Let's go through the sector preferences. Energy, healthcare, discretionary, industrials. Can we start with energy and discretionary? How do those two things work with one another. We've got energy breaking out recently, Brent crude getting back close to $90 a barrel, energy equities picking up off the back of that. How do you reconcile the view on energy with the view on discretionary?
Yeah, absolutely. We've been adding cyclicality to our portfolio. So on one hand, we like energy. Energy's perked up a little with WTI over 80, right? But that's still a pretty reasonable level for oil prices. But it was good to see this sector respond. I like energy for a couple of reasons. One, it's inexpensive value-wise in terms of free cash flow and in terms of earnings. I also think it provides you a little bit of a way to position for a world where energy security is an issue, right? Red hot geopolitical world. We just heard from Liz on the consumer. We have a consumer that is largely stable. Our internal data shows the consumer is very much on 2 feet. Now, we're seeing normalization in spending patterns, of course, still from the COVID era. But I think you have a strong labor market, and as strong as the labor market stays, the consumer will go with it. And I think that leads an opportunity for discretionary.
That's the cyclicality. Let's deal with healthcare. Traditionally, that would sound super defensive. But as we know, healthcare is basically just a couple of names surfing the GLP-1 wave. And I'm trying to work out, when you suggest healthcare, are you saying GLP-1s, or are you saying more broadly there's something else happening here?
I think more broadly, right, it is that crossroads of innovation, right, and technology and healthcare and wellness and all of these things. But I also think healthcare gives me this nice mix of quality, some nice dividend payers, dividend growers, right? It gives me a little bit of a buffer of the ups and downs of growth, and it can withstand macro pressures. You know, you mentioned GDP. Atlanta Fed GDP now is showing some slowing, some moderation in growth. So while I think the economy stays strong, I think it comes off the boil that it had been on.
How much of the gains in some of these sectors are driven by NVIDIA? And I say this because yesterday there was this conference and they announced a bigger and better chip that cost $50,000, twice as much. And I just wonder, if you're going to leverage the gains in productivity in your portfolio, why not just 3 times lever NVIDIA shares?
Well, we already saw the Mag 7, the Magnificent 7, go to the Fabulous 4, the Fantastic 4, right? So you're seeing a broadening here, and I think that's going to be the story for the rest of the year. So yes, so much enthusiasm about artificial intelligence, but as we saw, it's about real demand. It's about the follow-through, and I think that's the story for 2024 is what's next for artificial intelligence. And I think there can be so many more beneficiaries. But I think value starts picking up from here. You know, 80% of the S&P is trading above their 200-day moving average. That gets me excited that this rotation may have legs.
What's the buffer asset class? Is it just cash, or is it still bonds?
No, it's still bonds. So we recently upgraded equities, but it was a view of adding risk on the equity side and being really fully invested there, not a view about bonds. We still like high-quality fixed income. We like treasuries. We like mortgages. We'd be slightly beyond benchmark duration here. Fixed income is providing real yields and diversification.
You said geopolitics concerns you. It doesn't sound like there's any geopolitics baked into here. Where does that come into play?
Industrials, defense, right? When I think about especially international defense spending, that's a little bit less of a U.S. story and more if we look at the rest of the world. I think defense budgets are going to be rising. And I think we're in the early innings of defense. And I'll also have to add cybersecurity in there.
Just to wrap things up and put a bow on it, Merrill and Bank of America Private Bank, you don't think we should be 3 times levered NVIDIA, right? Just to clear that up. Is Bramo getting excited about big levered single name trades?
I mean, no, I'm just thinking to myself, this is actually what people were doing.
You're going to go to private bank clients, that's going to be the pitch.
Did you see what the options market was doing around NVIDIA?
Yeah, I know.
I mean, it was literally like, you know, the sort of penny stocks.
Alex Weber Bloomberg said this yesterday. It feels like the new Apple conference get-together product launch, right?
On steroids.
Amazing. Marcy, thank you. It's good to see you. Thank you very much. Marcy McGregor of Merrill and Bank of America Private Bank.
That was a no. They're not recommending.
No, I'm sure.
Leverage NVIDIA.
Clearly it was a no.
Well, I'm just letting you know.
Let's set up the next hour on Bloomberg TV. Coming up next, we'll be catching up with Brian Moynihan, the chairman and CEO of Bank of America. We'll also catch up with Candace Browning, the vice chair of the Bank of America Institute, and Wendy Stewart, the president of Bank of America Global Commercial Banking. That is a stacked 60 minutes here at Bank of America. Lisa, coming up.
Yeah, I'm really looking forward to it. I also really enjoy being in everybody's different homes where you hear the different noises and you kind of understand what their environment actually is.
What do you mean, the different noises?
Well, the different beeps.
It's nice to hear the Bloomberg terminal.
But it was just.
I know that's the IB beep.
I know, but it's enjoyable. It just makes me feel like a pulse.
That is music to Mike's ears. Just that beep beep beep.
And yours too.
It's a beautiful thing. I love it as well. Sure, that's the alarm in the morning.
Yeah, exactly. Bump, bump, bump.
From New York City, the second hour of Bloomberg Surveillance. Up next.
this rally since October has all been about big tech. The rally's definitely been broadening out a little bit, but very, very early days.
In terms of getting even more bullish, if you will, on the equity side, we're just going to have to see some broadening of breadth, if you will.
Put the Mag 7 aside. The other 493 earnings were down last year. We think they'll be up this year.
There is a broadening out that is happening in the market, and I do like the cyclical strength.
This is a pretty favorable operating environment for corporate America.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I have to say, maybe it's just a coincidence that Brian just arrived and everything got very busy and loud very quickly. Maybe it's just a coincidence.
He did point out that maybe some weren't in early enough. So, maybe
they're all working hard.
Yeah, exactly.
Sure. From New York City this morning. Good morning. Good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 just a little bit softer this morning. The theme of the first hour right here at Bank of America's home in New York City. This economy is looking pretty resilient based on what we've heard so far.
I would put it this way. Bull.
Yeah, kind of.
Bull.
Yeah.
I mean, it was just incredibly bullish in the sense that maybe things are not slowing down very much. I really do think that Mark Abana summed it up when he said that maybe it's not stocks not listening to bonds. It's bonds not listening to stocks.
We've said this a few times. If you think about what we were priced for at the start of the year, we were talking about 6 rate cuts in 2024. Markets come down to 3. There's a risk tomorrow the Federal Reserve takes that median dot from 3 to 2. You've seen the front end of the yield curve reprice from around 4% back to 4.70. Equities, super calm. We've asked the question, so long as they remain calm and credit spreads remain tight, does that open the door for yields just to keep on pushing higher?
We've asked this question to people who actually lend to small businesses and said, right now, is it restrictive? Is it difficult for them to pay back interest rates where they are? The answer, no. Are you seeing credit stress as a result? No. Is it just survive until 25, or is this a new reality where margins are increased and actually inflation has been beneficial for businesses that can charge more and have bigger revenues?
We'll get into that new reality in just a moment. Let's start today, this hour, with some price action for you. Equity futures on the S&P 500, just a touch softer, a little bit negative on the S&P. We're down by something like 0.1%. You're probably interested in what's happening in foreign exchange, given the BOJ did hike interest rates for the first time since 2007. Who would have thought that event itself would be a total snoozer? Yen weakness, not strength. Dollar yen breaking out by almost another full percentage point to 150.54.
On brand. That's all I'll say. It's completely on brand for the Bank of Japan in this particular moment where they are just trying to signal that they are done with negative rate policies. That doesn't mean it's a series of rate hikes that are coming at a time where they're still putting a priority on getting inflation up to 2%, not down to 2%.
Yep. Dollar strength, the story yesterday, on repeat again this morning. Through the next hour, here's the lineup for you. It's pretty special. Brian Moynihan, the chairman and CEO, on the outlook for the bank and the broader economy. Candice Browning, the head of global research, on the latest fund manager survey. And Wendy Stewart, the president of global commercial banking, on the unit's surge in new clients. We begin with our top story. The S&P 500 snapping a 3-day losing streak as investors begin to turn their attention from Jensen to Jay. And the Fed meeting starting today. Joining us now, I'm pleased to say, Brian Moynihan, CEO and chairman of Bank of America. Brian, we have to say thank you. Thanks for having us.
Oh, it's great for you to be here. These talented teammates are out working early in the morning and hopefully making some money for the shareholders.
It's getting noisy. We could talk about how much money they're making in just a moment. I actually wanted to start with a quote from Liz from the Bank of America Institute in the first hour of our coverage here. I find this stunning every time I read it. This will be the 5th time already today. Median value of savings and checking balances are more than 40% higher than 2019 for all income levels. As you look across the business, consumers, companies, just how resilient is this economy still?
Well, Liz and the team do a great job of putting this out, and we purposely created the Institute so we could get this data out. And it's not a reflection of what's coming tomorrow. It's more a reflection on what you see in the past. But it's very granular, 60+ million customers, 37 million checking account holders, and they have been remarkably resilient. And so the idea, if we were sitting here last year, this time we'd be talking about our team was predicting a recession somewhere early this year. It didn't. Then they took that off the table as we moved through the year, and now they're predicting 2% plus growth for this quarter. So you've gone from negative to slightly positive 2%. That is returning to the mean. It's not outsized growth. It's actually slowing down. So people can't forget we're going from a 4 to 5% growth rate to 2.5% growth rate is slowing down, and the restriction on the economy accomplishing its purpose. Meanwhile, the consumer is very resilient, and that's providing an anchor to windward that the Fed has latitude that a lot of places don't have, that they can be hold restrictive and let the economy really catch up. but they have to be mindful of the change. At some point, that consumer will slow down, and they have slowed down their spending. And so last year it had been 10% growth. This year, in the fall, 5%. Now it's down to 3 to 4%. And they've got to be careful they don't overshoot. So this is the tension we're in right now, which is this resilient economy and actually, as you said, Lisa, actually trying to bring inflation down. Since the financial crisis to now, most central banks are trying to get inflation up. And so it's a completely different execution, and that's what we got to get right.
You're dominant in small business lending. Yeah. I'm just wondering just how much confidence there is out there still in corporate America at the lower level, in the small companies across this country.
If you say by virtue of their activity, it's strong. But on the other hand, line usage, and Wendy will be on here later, she'll talk about that. Line usage has come down a bit, which means that the cost of borrowing went up, and so therefore I'm a little more careful. And so hiring's a little more careful. Equipment purchase, a little more careful. And so, well, they're fine making money, and the profits are strong, and the team will talk about profits driving this market and the EPS estimates for public companies. Even mid-sized companies are participating in that. The American economy is the dominant economy in the world right now in terms of activity and interest and investment, and lots of good trends for it. But on the other hand, why aren't they using their line so much? It's a little more costly, therefore you're a little more careful. And that's the tension we're going through. Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing a little bit of tension here. So everything's fine, solid, resilient, all the words you wanted to, but it has to sort of work the next twist in the economy to get back to normal.
It's funny. I hear some of the people who work for you, and they sound incredibly bullish. Nothing's wrong, whatever. Is it your job to basically look around corners and see what potentially could be the problem, but otherwise things are screaming, and it suggests that even 4.5% 10-year rates would be just fine for the lending and the activity that you're seeing?
Well, I think we're also adjusting as a company and as an industry and as a society to a simple thing that from 2007 or 8 till 17, you had no interest rate. Then you had interest rate for about 24 to 36 months. Then they were dropping rates in 2019. Then the COVID comes and they drop. So we've never really had a normal interest rate environment. What would have typically been a 3% front end rate, 4 to 4.5% back end rate, a normal sloping curve, real interest rate. It hasn't occurred for anybody under 40. They literally weren't working back then. So, that sounds curmudgeonly, but the reality is that's true. So everybody's adjusting this. So these high rates at 4.5% in the 10-year are not high rates in the grand scheme of things. They're high rates in the last 15 years. So we got to adjust to that, and that'll take time to work through the systems and models and thought process. Our team is the best team in the world in research, and you're going to hear from a lot of them today, and your viewers will benefit. On the other hand, as you look at it more broadly, my job and the team's job at the top of the house is to make sure we're balanced for all outcomes, and that's why we're always worried about what happens tomorrow, and we plan for it.
The balance in outcomes is leading to some really frustrated and bored traders, and we talk about that with a lot of people who basically say there's not a lot to do because you can't really get an edge. Are you seeing that in trading activity? Are you seeing that in trading revenues as people basically have no incentive other than just to hold NVIDIA, hold on to, some of the credit that keeps on rallying and just, make bank?
Well, our team has just come off of last year a record amount of revenues in the quarters, a record in growing quarter over quarter, and we think they're going to fare well this quarter. We told the market that a few weeks ago. And so Jimmy DeMar and the team that's out here, the research team under Candace and the investment banking team under Matthew are driving the business and actually gaining share. And so while pools are down, investment banking, we've gained some share there. While pools are stable, flattish, we're actually up, and that's different in this business. And they do it with the right risk. They made money, I think, every trading day last year, nearly every trading day for the last 5 years. And so they do it the right way. Is that boring or not? You have to ask them. It's just fine with us because at the end of the day, that recurring capability, that ability to keep delivering for clients and doing what they need to do and make money at it and deliver for the shareholders and get a return on capital is what Jim and the team have done a great job.
You alluded to it. Have you maintained that momentum from that record fourth quarter?
Yeah, we think we're this quarter start off well. The team's doing a good job, and when you get to be bigger and bigger, it's hard to keep that growth going. They keep doing it.
Can we talk about the M&A slump as well? Are we working our way out of that? We wake up every single morning, we've got a new big blockbuster deal, and then we have a conversation about whether they can actually close it or not because of antitrust concerns down in Washington, D.C. Do you find us exiting that slump this year? Is that what you're looking for?
I think until there's a a clarity on policy, that question is going to come up every time a deal is announced. So the companies are actively engaging in a dialogue, trying to figure out the strategic moves, and then the question is, can they get the deals through? And that happens in all industries. We need to get this resolved. We need to get to a more rational, predictive outcome to have people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. The buyers put themselves somewhat at risk. The sellers really put themselves at risk because a company, hanging in abeyance for a longer period of time is a tough place to be. Having been there before in my life and having caused people to be there a lot in my life, it's a tough place. And so how to run the company, what you can do. So I think we need to get a faster turnaround. The idea is these transactions don't change this month or a year from now. They're the same transaction. People need to get after them, look at them, decide what they're going to do, and give clarity so that the market takes place. The good news is, investment banking revenues have stabilized and moved back up, and that's good. But the M&A piece is still the piece that could come on and push through.
Do you find that some clients are reluctant to make deals based on what you just
100%.
said? Even though they make business sense, they just don't even want to entertain the conversation?
Because the risk-reward balance is so tough. Not everybody has the staying power to fight through, lawsuits and time and effort and things like that. And so it really requires if you said you needed 10 points of strategic import out of 10 to do it 10 possible points, you might need 7 before. Now you need all 10 because you really have to say this is worth hanging on to and fighting through. That's a different environment. Now, against that, you are seeing deals announced, and that's because they make strategic, compelling sense for that buyer, seller, et cetera. But it's just been slowing things down, and I think as there gets a rationality here and around the world, because remember, none of these deals are simple anymore. For any company, they have operations in Europe where there's same sets of approvals or different sets of approvals and operations in other environments. But at the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
So let's just talk about some of the policy shifts, which is nice, gentle allusion to the election later on. Potentially they could offer some more certainty. What kind of M&A boom could you see after that certainty has been established?
We'll see. I mean, I think, elections are elections. This company, the oldest part, has been around since 1784. And, there's been a lot of elections since that time frame. And, we have to adjust. I think you guys asked me in Davos, do you have a drawer for one outcome, a drawer for... The answer is no. We just run the company and drive it. So, I think certainly around the election process here and around the world, we'll add to, okay, we know what we're dealing with and go on. And so that'll create some energy. But I think we have to be careful to say one thing leans one way, one thing leans like, because frankly, the politicians have to get this right for the good of their own state economy, country economies and stuff. And I think they're all struggling with it.
So we talk to a lot of strategists, political policy strategists, and they all say no one can really quite believe that it's Trump versus Biden again. And so they're trying to figure out who it's really going to be. Is it going to be you?
Me what?
Running for office. I mean, this is sort of what people are talking about. They're talking about Jimmy. I mean, this is sort of something that comes up in your discussions.
No, I've got a great job here.
I had a feeling you wouldn't put your hand up to be Treasury Secretary in front of the team this morning.
I know, right? You want to make sure
I've got a great job. At the end of the day, our job, my colleagues that are in the leadership across all industries, is to help any administration be successful, and that's what we try to do here and around the world. And and those are tough jobs, and but I don't think I'm running for office, so I think I've got a great job here, and I've got to continue to do it and try to help this team and everybody be better than we could be tomorrow than we are today.
There's been some fires to put out over the last 12 months in the industry. It's been a year since SVB failed. NYCB has been a new issue. Seems like last year was a rate shock, and this year just big worries about maybe a credit shock. Have you noticed any deposit flight coming towards you from regional banks in any way, shape or form similar to what we saw 12 months ago?
There hasn't been the kind of change there was last year because there are unique business models. That's what's not involved. There's a little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere. And the industry is well capitalized, has good liquidity. Believe me, from last year to this year, people short up their liquidity across the industry. Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working at. But, the trading attitude, which is these assets got to move at a price tomorrow morning, isn't the way the banking system works. And frankly, that's the value of the banking system. We work with clients. We figure out what you take a building, you figure out what the ultimate end state rental rolls will provide. You refinance it. Sometimes that wipes out the equity. Sometimes it doesn't. We're careful in how we underwrite as an industry. The top 30 banks go through the stress test, which has an effect that says, wait a second, if you're underwriting out in an odd way, you have to put up the capital to prove you're right before you even get the chance to prove you're right. So in other words, your capital requirements will reflect your underwriting today, even though recession may never come. And it reflects your underwriting commitments under a scenario where commercial real estate drops by 30 or 40% instantaneously. So there's an effect on that on the industry, which is much more conservative building and much more middle of the road building, which is probably slow down the capital provision to some of these companies. But on the other hand, it's not a bad thing when you get to this point. So we feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
When we caught up in Switzerland, we were talking about the prospect of a change in capital reserve rules. Chairman Powell in his semi-annual testimony appeared to back away from that. What was your reaction to what Chairman Powell had to say in the last couple of weeks?
Well, we in the industry and we at Bank of America believe that we have, tremendous amounts of capital, liquidity. It's tested, the stress test. We don't need to keep moving the rules around. We're clear about that. And so, I think as people look at this, they're saying sort of what's the reason? In the end of the day, U.S. banking system and the U.S. economy are coexist with each other. And the U.S. economy has grown from pre-financial crisis now. The European economy has grown a lot less. The U.S. economy is much more vibrant. It's recovered from the pandemic shock faster. It's absorbed some of the things. And everybody says, well, that's because X, Y, or Z. But the reality is it's because the kind of capitalism practice in the country is good, and the kind of banking system, financial system more broadly, helps that happen. And so, we've weathered storms. Just think since early 2000, we've had a pandemic, recovery from the pandemic, the fastest rise in interest rates, 2 kinetic wars on the ground, trade debates around the world, shipping restrictions. You go through all this. In the end of the day, this industry, we made $100 billion after tax from 2020 through now. And we built huge reserves, we took them back, we dealt with the pandemic, $70 billion of borrowing overnight, a flood of deposits, some of those deposits come out. That's the resilience of the system, and that's why we got to be careful about adding capital and stuff when the perceived risk we don't think justifies.
In the meantime, there has been a shift in terms of consolidation of market share in some of the bigger players. And you were talking about how you were gaining market share. Who are you mostly gaining market share from? Is it the smaller banks? Is it from Europe? Where in particular?
Each of our businesses, our 8 lines of business, have different places they gain from. And so when it's the investment banking and with Matthew Coder and the trading team under Jimmy, that's largely coming from the long tail people. This business is hard. It requires about $1 billion of technology investment a year to have a trading platform to keep up with it. So think about that.
Wow.
So when it's that hard, that means people who don't get the returns on capital have quit, and it's come this way. That's very different from the consumer bank, where Dean Athanasia and Holly O'Neill and Aaron Levine that run that business for us have just been driving core account growth. And so, they give you the statistics about constant accounts. We've grown our consumer base probably 4 million core checking accounts since the pandemic. So the deposits are up because of those extra balances. That's coming from everywhere. So it really comes from different places, but the idea is our job is to win the market and take it from every place.
When you talk about the investment in technology, how much is that going to be an ongoing benefit to a bank like yours that can invest in some of the artificial intelligence that we're hearing about every day?
So I think if you think about, we got to be careful about artificial intelligence versus machine learning versus digitization versus digital practice, because it's all different things. But let me just give the simple stats. In 2010, we had 100,000 people in our consumer business. Today, we have 60. We had 6,000 branches at the high point about 2008. We have about 4,000 now. We had about 400 billion deposits. Now we have 900 billion. The amount of transactions going through is light years bigger, and we're doing it with 40,000 less people. And the expense base we run the whole company on today, nominal expenses of $64 billion, round numbers, is the same we ran it on 2015. That is all the stuff you're talking about. That's applying technology over and over and over again. And are we perfect? Absolutely not. Do we have room to keep applying? Yes. Is there plenty ahead of us? It's unbelievable. And so if you look ahead, we're basically running on neutral headcount, and everybody says, well, you're not hiring. We're hiring people in businesses and putting revenue generation capabilities out there. At the same time, we're taking out of the expense base, and that's a constant strain. And it's pretty remarkable what you can do. But if there was some way you snap your fingers and change the whole thing, you would have done it. I mean, we're not.
What you just said, though, is so important, and can we finish there? I was going to jokingly ask you whether we'll all be replaced by a big supercomputer in the next 5 to 10 years, and I think a lot of the people behind us would like to know the answer to that question as well. But I guess effectively in the next 5 to 10 years, are we effectively saying that each additional dollar of revenue is going to be less and less labor intensive because of this adoption of technology?
We had 300,000 people. We have 212,000 today. It's going to have less labor content. Are those people paid more? A lot more, because the way the labor content shifts. And so if you think about it, it will have less labor content because that is the expensive part, but it'll have more value added from labor because that's the way the mathematics will work. And so, as you think about these trends, they're inexorable. They just keep going on. But people are forgetting these trends are already going on. And so one person's AI is another person's, algorithm models that traders have been using for years. One person's AI is another person's Erica, which is 18 million customers using it, every day type thing. And so you got to be careful about it. Is there potential here that we've never seen before? 110%. But the real question is, you don't have to wait for that potential. You're taking it out every day if you're working at it.
No 3-day week coming to Bank of America anytime soon? Is it Jamie who said that? 3-day week?
I'm not sure I understand the math there, but our team does a good job. They want to work 5 days.
I'm sure they do. They're nodding away. Brian, it's good to see you. Thanks for having us. We appreciate it. Brian Moynihan there, the chairman and CEO of Bank of America. Equities right now on the S&P 500, a touch softer, a big week ahead of us. Up next on this program, NVIDIA unveiling Blackwell.
This is Hopper. Hopper changed the world. This is Blackwell.
That conversation up next. Live from New York City this morning. Good morning. Just a flavour of the price action for you, starting with the S&P 500. Equities a little softer this morning. No real drama. We're negative by what? 0.4%. Losses build just a touch here, Bramo. Not much to talk about. Basically, in the equity market, we've been okay for the last couple of weeks, even with this big repricing we've seen in the Treasury market.
We had 2 straight weeks of losses. It sounds scary. It's less than 1% both weeks combined. We basically gained it back in a couple of hours. The key question for me is what's going to ultimately shake the conviction that this market has, that there is ultimately strength, there's ultimately promise, and we seem to be in a market that wants to rally.
We need to talk about NVIDIA just a little bit. Under surveillance this morning, NVIDIA announcing its newest AI processor, the follow-up to its signature product that fueled NVIDIA's explosive sales and sent its valuation soaring. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, it felt, let's just call it Steve Jobs-esque yesterday. How much of that was a repeat of what we used to see from Apple?
Yeah, look, their product cadence continues to be improving, and they had everything in there in terms of, focusing on LLMs, training, inferencing, announcing a lot of partnerships. Almost every tech company, it seems, is partnering with NVIDIA. So clearly, every 12 months, they're going to come up with new architecture, and that bodes well for their moat. I think the competitors like AMD and Intel will find it hard to catch up at this pace.
Why then, Mandeep, why are the shares down today?
Well, so it's an expectations game. I mean, back, 6 months back, expectations weren't for them to do $100 billion in data center sales. So clearly the bar keeps going higher and higher. And at this valuation, over $2 trillion, we could argue stock is not going to 2x from here, regardless of what they do. And this is a cyclical industry. So they will run into that CapEx cycle, cyclical slowdown. That will happen, whether it's 6 months from now, 12 months from now. And that's why valuations, multiple expansion is very unlikely from this point on.
This is what Alex Webb told us yesterday, Bramo, when he was talking about this event, anticipating it, that maybe it would be a Southern News event in the same way that the Apple events used to be under, say, Steve Jobs launching a new iPhone.
Because there just was so much hype. That said, in the options market, I have to say, I am fascinated by the options market right now because it just is full of people who want
the bullishness.
The bullishness. There were people betting that the share prices would double. That you basically have double the valuation.
Right, in a short period of time as well. I know, it's crazy.
Yeah.
Up next on this programme, and Mandeep, thank you. We'll be catching up with Candice Browning, the head of global research at Bank of America, on the latest Fund Manager Survey. Top tip, if you're bullish about anything, Pay to bring Bramo round to the office, and she will talk you out of absolutely anything.
Okay.
Anything you're constructive about.
You know what?
Possibly happy about doing.
You're projecting. I think that you would do the same. If I were not here, you would do the same thing.
I'm just not as bad as you. That's all.
You mean
It's all
you're more subtle?
relative.
But carry on.
From the home of Bank of America in New York City, good morning to you. Caught up with Brian Moynihan in the last 30 minutes or so, the CEO and chairman. I have to say, my takeaway from that conversation around mergers and acquisitions, the amount of companies, clients that would possibly entertain a deal, that don't want to entertain a deal because they'd be hanging around for so long waiting to see if DC would approve it. That's a problem.
Particularly if they're of a certain size, which makes me wonder, if you think about companies that have cash and they want to make a purchase, all the smaller companies that are suddenly really attractive acquisition targets because that won't get caught up in some of the antitrust and other kinds of regulatory issues.
We'll return to that theme in just a moment. Let's start with the price action for you. Beginning with equities, we'll work our way to bonds and finish on foreign exchange. In the equity market on the S&P 500, pulling back just a touch. We're negative by 0.4%. We snapped a three-day losing streak on the S&P in yesterday's session. Pretty decent day, actually. Pretty much every single sector on the S&P 500 positive by the time we got to the close. On the Nasdaq, we are negative by 0.6%. I want to turn to the bond market. Already heard from Mark Cabana of Bank of America this morning about the prospect of yield to the long end drifting even higher. Here we are at 432.63, nowhere near the highs of last year. But the fact of the matter is, we came into this year and consensus was, and consensus still is, that yields are going to be lower by the end of the year. The front end of the curve pushing back against that and pushing back against that hard. We've gone from 4.1% to 4.70 in just a couple of months.
Remember when people were calling for 7 rate cuts this year?
I know.
Remember when that was sort of a base case, and it basically was this assumption that the Fed was just putting 3 rate cuts out there because they just wanted to basically sandbag the market before they really started cutting aggressively. This, to me, is one of the biggest surprises. And Mark Cabana nailed it when he said, you know, ultimately, is it bonds that have to catch up to stocks? Are stocks sending a very strong signal that people just aren't listening to?
That the economy is okay. And we'll talk about that economy in just a moment, because basically what we're seeing from fund managers is that this economy is better than okay. I want to finish on foreign exchange and talk about the Japanese yen. Dollar yen. Is this the 6th day of yen weakness?
Yep.
I think it is. 150.44. Positive by 0.9% on that currency pair. That is a weaker Japanese yen in the face of the first hike in 17 years.
Which just shows how you can get the direction right and get the trade so wrong. Because if you take a look at the rhetoric that we heard from the Bank of Japan, it was, here you go, we're doing what you asked us to do. We're going to also remove yield curve control. Sounds really hawkish. We're very concerned about economic weakness. We don't know whether this price pressure can handle it, it can subsist. We don't know about what's going to happen with China. And all of a sudden, the yen just, that was the sound of it.
You have to compare and contrast. That was beautiful, by the way. You have to compare and contrast the start of the rate hiking cycle at the Federal Reserve. Compare it to the start of the rate hiking cycle, if this is one, at the BOJ. The BOJ wanted disinflation. They'd been fighting for it. It was a once-in-a-generation opportunity to reset inflation expectations higher. The Federal Reserve did not want this inflation. So that's why you're getting very, very different communication off the back of the first hike from the BOJ compared to, say, the Federal Reserve and the ECB.
I do wonder 2 things, whether this is turbocharging equities in Japan, because now it's even more of a discount, right, for people who are buying internationally. But second of all, if the Bank of Japan gets nervous, if, say, the Fed is more hawkish, what that does to the weakness in the yen, and whether that becomes a problem in terms of bad inflation that's imported from outside.
Dollar yen, a clean break of 150.43, up by 0.9%. Let's turn to that survey. Bank of America's latest fund manager survey showing risk appetite at the highest level since November 2021, and investors rotating into Europe and emerging markets at the expense of US tech. The brilliant Candice Browning, the head of global research at Bank of America, joins us around the table. Candice, good morning to you.
Good morning, John. How are you today?
Wonderful. Thank you very much for hosting us. I want to talk about the highlights of the latest survey. Just bullish, bullish, bullish. Global growth expectations, 2-year high. Risk appetite, the highest since November 21. EPS optimism, 2-year high. How does this one stack up to the one we had last month, the previous month, the month before that?
Well, everything has ticked up a little bit across the board. Even some sentiment regarding China, although people are still very negative about China overall and think it's kind of in a secular decline as it relates to the markets. But what I think is really interesting about this fund manager survey is what you said, and the title of it is Bulls Go Global. So basically what this fund manager survey is showing is that expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. And that's why this fund manager survey is different than the prior months.
Can we get into that growth optimism then? Are we saying it's not just the United States? We're hoping for better growth out of Europe, out of China, out of Asia?
Yes. That's exactly what we're saying. And in fact, we have a proprietary indicator called the Global Wave, which is different than the Fund Manager Survey because the Global Wave is an amalgamation of just economic data. So things like industrial production, consumer confidence, earnings revision ratios, things like that. So it's just facts amalgamated all together. And that Global Wave troughed in January of 2024. Now, statistically, after the Global Wave troughs, emerging markets perform the best, and on average, they're up about 19% in the 12 months following the trough. The U.S. does well, too. Japan does well. Asia does well. The U.S. just does a little less well than all of the other areas. So, yes, it's this broadening out of growth.
I wonder how predictive some of these fund managers' feelings are. This is sort of one of the key questions when I get this is this a contrarian indicator? If everyone's going bullish and it's going global, is this something that, we should get concerned about, or is this a forward-leading indicator?
It's a great question, and we do have an indicator called the bull-bear indicator, and when it's above, I think the number is 8, that is a contrarian indicator, because people are too bullish, right? Right now, that indicator is around 6.5. So we're not in that extreme bullishness area yet at all.
With all of these indicators that you are sort of putting out there, and I've got to say, I find it interesting, is there a competition between the surveys? Do the different units that run their own surveys sort of say, mine's more predictive than your survey a little bit?
A competition, internal competition can be a good thing.
So that's a yes. There's a lot of, crap talking each other. But I am wondering about, what you find the most reliable kind of North Star at a time when we're looking for what can have predictive value in a very messy data environment?
It is a very messy data environment, and I try to look at these as a mosaic rather than have one North Star. We have 84 of these predictive indicators, and the bulk of them have been rising since 2022. We've seen a real breakout in a number of them, particularly the industrial indicator. The semiconductor memory indicator is at a 7-year high, and that's very important because we all know semiconductor cycle, leads the global economy statistically. And then we've got an indicator which looks at digital advertising. That's a relatively new one, and that one has also been breaking out, and that's good for consumer and service economy, particularly in the U.S. So you've got industrial indicators, tech indicators, and consumer indicators all breaking out, which fits with the global wave and what the Fund Manager Survey was saying.
Can you help me understand sentiment? Sometimes on this program, it just feels like this. Everyone that comes on is bullish, sentiment's pretty solid, maybe on the edge of euphoric. I think we'll catch up with Savita Subramanian in about 20 minutes' time, and she'll tell us that this market is not euphoric. How do you gauge sentiment of those 84 proprietary indicators? How do you gauge that?
Well, the sentiment indicator, the main sentiment indicator really is this Global Fund Manager Survey. That's a sentiment indicator. The global wave is just pure economic data. And that contrarian indicator that I was talking about before, the bull-bear indicator, would indicate that sentiment is bullish, but it's not extremely bullish yet. It's not euphoric.
Are we benchmarking to extreme times like 1999? Is that what we're benchmarking to?
Yeah, I mean, this data for the Fund Manager Survey goes all the way back to 1994. So,
wow.
Yeah, long time. And as a matter of fact, the jump in the allocation to EM was its highest since 2017. That's a big jump.
Honestly, I'm glad that you asked that, because you start talking about it's not euphoric. It's optimistic. It's pretty bullish, but it's not euphoric. I mean, divine euphoria. Everyone who comes on is basically talking about how incredible everything looks and how surprising and strong it looks.
Yeah.
You start to wonder.
It's a question I often ask, Candice, just how valuable is it to benchmark to an extreme? To say that it's not 1999 doesn't necessarily mean it's good.
Right.
Is it useful?
I think look, history does not repeat itself, but you can learn from history. So I think having these indicators and having these benchmarks and looking at prior times is very healthy. But the world forward will be it will look different.
So let's talk about sort of the third rail right now, or perhaps the first rail for certain executives, which is the use of machine learning and AI in some of these indicators. How much are you actually deploying the ability to sort of take data points from data sets that you have, put them together, stick them through a machine, and get a response, bull, bear.
That's exactly what we're trying to do with these indicators. And we use, we use machine learning, we use all different techniques, and most of them are aggregates. We never would have been able to do these indicators 5-10 years ago. We didn't have the capability of aggregating all this data together. And I think you're going to see more and more of this done across markets. And what I think it means is we're going to get better and better real-time information. I mean, you heard Liz talking about the Institute. We're looking at 69 million accounts. That's a lot of data. That's not sending somebody a survey in the mail and getting them to respond. Real-time data on 69 million accounts. And I think this is a wonderful thing about AI. And I think it will allow policymakers to respond more quickly to better information.
Can we finish up by talking about the future of global research and what it's going to look like in 5 to 10 years' time? We spent so much time in this program talking about a shift away from public markets to private markets, a move away from single names to passive index investing over the last 10 years. Is the nature of what you do changing as well? Do you move away from single name coverage towards something else? What's this going to look like?
Yeah, we've been dealing with that issue for a very long time, and one of the things we've tried to do is to change the types of research that we're doing. So I'll give you a great example. ETFs. We cover more than 400 ETFs. People think all ETFs are the same. If you buy a sector in ETF, the bank sector, you're going to get the same performance. You don't. There are dramatic differences. So the ETF research, stuff on passive, we're changing the kinds of things that we're focusing on. But at the end of the day, we still need to do the basic single stock and single security to build up to those broader, passive securities.
So if you're at college right now thinking about a future, there's a future for them still?
Absolutely. Research is a great job. You know why? Because you get paid every day to come in and think. How great a job is that?
And you get paid more than academics to do the same thing.
It's actually
beautiful
true.
thing.
I'm just thinking about Woody Allen and The Sleeper, and you have a machine being like, put in your data points and then spitting out, bye.
I'm pleased they picked you up on a single shot there of that robot impression. Candice, we're going to leave it there. It's great to catch up. It's good to see you.
Thank you so much.
Thanks
Great
for hosting
to
us.
see
Thank
you.
you. Candice Browning there of Bank of America. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. We can catch up with Shonali Basak. Hey, Shonali.
Good morning, John. The Reserve Bank of Australia has signaled that it's finished hiking rates, and it sparked a sell-off in the nation's currency. The central bank kept its policy on hold for a third straight meeting and made no reference to further increases to rates that already sit at a 12-year high. And Reserve Bank Governor Michelle Bullock said they need more confidence in the downward trajectory of inflation before considering rate cuts. The current forecast is for a return to target in late 2025. And Secretary of State Antony Blinken will make his 6th visit to the Middle East since the Israel-Hamas war broke out, making stops in Saudi Arabia and Egypt. The visit comes at a time of increased tension between the U.S. and Israel over the situation in Gaza, with Senate Majority Leader Chuck Schumer and Israel Prime Minister Benjamin Netanyahu exchanging verbal blows in recent days. And Hong Kong has fast-tracked a measure further cementing China's control over the global financial hub. The approval of Article 23 completes a 2-decade campaign to pass local legislation protecting the Chinese state. New crimes such as treason and insurrection carry life sentences. The measure already broadcasts defines state secret offenses in line with China's vague legislation around espionage. The move raises questions over the city's status as an investment and tourist destination. And John, that's your Bloomberg Brief.
Shonali, thank you. Up next on this program, commercial real estate in focus.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties in reworking that.
That conversation up next, live from New York City. This is Bloomberg. The two-day Fed meeting begins in a couple of hours' time down in Washington, D.C. Going into that, here's the price action on the S&P 500. Equities pulling back just a touch on the S&P. We're down by 0.5%. Yields pushing higher over the last week, 432 on a US 10-year, 470s on a 2-year. Dollar stronger yesterday, again this morning, 108.51 on euro dollar. Check out dollar yen. Dollar a whole lot stronger against the weaker Japanese yen, 150.42. That's a move of 0.9% in the face of the first interest rate hike in 17 years from the Bank of Japan.
Wow, it's sort of like...
you wouldn't know it, would you?
It'd be just kicking over the cross line. I mean, this is basically what they were hoping for. There were report after report after report saying, we're going to do it, we're going to do it. Then they did it. No one cares.
An uneventful rate hike from the BOJ. Just baby steps. We'll see what comes next. Under surveillance this morning, commercial real estate in focus.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working that. We feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
It's the latest this morning. Clients of the Bank of America commercial bank soaring as it moves to limit its exposure to CRE, tailoring its commercial lending book to avoid properties most at risk. Joining us now to discuss is Wendy Stewart, the Bank of America Global Commercial Banking President. Wendy, good morning to you.
Good morning, and thank you for having me.
Thank you for having us, I was going to say. Thank you for hosting us. You shouldn't be thanking us. Let's talk about your business and how much things have changed. When we talk about commercial real estate, I think we don't narrow it down enough. How much have things changed for this business over the last, say, decade, a shift away from office to industrial? Could you put some numbers on that for us?
So it's definitely shifted. You know, when we think about our business in global commercial banking, it's much more than commercial real estate. That is a part of it, but it is not the only thing that we do. So we work with middle market sized companies, and we define that as companies that generate revenue that is 50 million and growing rapidly to $2 billion. And these companies, some are publicly traded, but a lot of them are privately held. And these companies are companies all around the United States. They're typically third to fourth generation now, and we're working with these companies not only in the United States, but also in Canada and all of their international subsidiaries around the world.
It's related, though, because some of your potential competitors in the past were some of these regional banks, smaller banks, that are constrained with respect to lending because of the commercial real estate loans that are on their books. How much are you gaining share from some of those smaller banks that don't have the same kind of capacity that you do?
So we did have a fantastic year in 2023. It was a story of growth for us. And there was a lot of market disruption across the board that we saw last year. And we did take share as a result of that. You know, I would say lending is not something where we are constrained. We also have a lot of other capabilities that we deliver to clients that really have nothing to do with our balance sheet that our clients want, whether they're digital capabilities, a lot of very unique cash management solutions, the investment we've made in international, the investment we've made in investment banking, and then also the focus that we have on new economy companies, which is something that's relatively new for us over the last couple of years as our economy is changing.
Well, I do wonder if there's sort of an opportunity to go a step further with the weakness that we're seeing in some of the regional banks to acquire whole units to expand. Is that something that's in the potential outlook at all?
You know, for Bank of America, we've been focused on organic growth. Responsible growth has been our mantra for many, many years, and we will continue to focus on responsible growth really through organic growth. And we have all the solutions that we need to be able to deliver for our clients. We just continue to invest, and we're really making investments in our team, so we continue to hire more bankers. And we're making a lot of investment in digital because our clients, they want to be able to bank when they want, where they want. They want it to be fast, safe, secure, and easy. And we've got great solutions to help clients on that front. And I'll give you an example. You know, we have a client recently that a new company we were working with, they were doing business in 13 different countries in Asia. And they were working with a variety of different banks. They were concerned about the exposure that they had. They couldn't manage the risk well. They didn't have a lot of visibility into, you know, just the day-to-day transactions. Plus, they had a lot of currency risk. And so we were able to sit down with them, look at all of their needs, put together a global solution, and they were very happy with that. So we are now their sole provider. So these are the types of ways that we're growing with our clients. And, you know, there's really not an acquisition out there that can help us with that.
Is that a trend? Are you seeing more of that in Asia specifically?
We're seeing a trend all over the globe. And, you know, when you think about U.S.-based companies and Canadian-based companies that we cover, you know, they've historically done business in North America. And they're really looking at taking advantage of the global growth that exists for them. And so, you know, we actually have three companies that we cover today, and we're not even through first quarter. And we've got these 3 companies, they're looking to grow. They've never done business internationally. They know that they need to increase their exposure. And so we helped not 1, but 3 different companies, different parts of the United States, different industries, but they all have one goal, and that's to grow internationally. 1 acquired a company in the UK, 1 in Italy, 1 in Australia. We helped all of them. And it's not just about M&A. It's also about the core banking needs that these newly acquired subsidiaries are going to have, and we can help them with all of it.
It's interesting hearing you discuss this, because I would have thought that life for a company is getting harder to go international. Life for multinationals is becoming more difficult because of policies and countries around the world seemingly putting the walls up. Is that not your experience?
So our experience is different. I mean, when you think about a multinational company versus a privately held company that might be in a generation transfer from the 3rd to 4th generation, they have very different considerations. You know, a privately held company, they can think about things over the very long term, where a multinational, you know, they may have different considerations. And so what we're finding is that our companies that we cover want to grow, and we are well positioned to help them with that.
Who are your competitors, your main competitors? Because there's been this discussion around, say, the Apollo or the Ares or the other kind of KKRs of the world trying to eat your lunch.
Right.
Is that the main competitor, or is it the other big banks? Is it everyone?
So we compete with everybody, and some more than others. And so obviously the large banks that you would think of in the U.S. are our big competitors. I mean, we do continue to compete with the regionals. You asked about the regionals. And, you know, as far as private lenders go, we don't compete with private lenders as much. The credit profile of our client is a little bit different than what a private lender would target. And, you know, we've seen really nice loan growth. We saw great loan growth through last year, and we're seeing good loan growth this year.
Do you see the growth, and it's interesting that you mentioned Europe, as stronger there? And do you sort of see cross-border transactions as stronger because the domestic ones are so difficult to actually get approved?
So we see a lot of good opportunity internationally all over the place. So, you know, certainly in EMEA, there's good opportunity. We will continue to invest in banker coverage there. We also look at, and we decide where to invest based on where our clients are doing business. And so we also see Asia as a good opportunity. And we have seen a lot of the reshoring that happened last year back into, you know, Mexico and into LATAM. And that was another good opportunity. So we will, you know, we added bankers there last year to take advantage of that.
I don't want you to tip your toe into the politics, but I have to bring up this question because we heard from the former president over the weekend that if you're a Chinese EV maker and you're positioning in Mexico, we're going to slap you with a 100% tariff. I do wonder about the future of nearshoring and whether it might be under threat. How do you think about those broader forces?
So, you know, we don't focus as much on the politics. We just focus on the needs of our clients. And so if our clients have decided that that's a good opportunity for them to, you know, move business back into Mexico, as an example, we have bankers on the ground that can support them, and that's absolutely what we're going to do.
Wendy, this was wonderful. It's great to get your perspective on things. Thank you.
Thank you very much.
After a monster year of growth last year.
Thank you.
Off the back of some difficulties elsewhere. Wendy Stewart there of Bank of America. Not the story we've traditionally heard on the international scene over the last couple of months.
No, but this actually speaks to the idea that there still is trade. It's not that there's been sort of a total protectionist kind of bent by companies. People are looking to where the opportunities are, and it is more of a global story. Fascinating to me also to think about, you know, where the lending opportunities are and that so many people still want to borrow.
Yeah. Next up on Bloomberg Surveillance, the third hour looks a little something like this. The special continues here from Bank of America. We'll catch up with Savita Subramaniam, Jill Carey-Hall, Michael Gapin and Lindsay Hans. Got to ask Michael Gapin, the prospect of those median dots maybe making another shift for this year at least, from 3 to 2. Is that the big risk factor for tomorrow? Is that it?
Dots.
3 down to 2?
Really?
Median
Dots.
dot?
Honestly, Claudia summed it up for me. She's like, I'm a dot hater, which I actually...
She's not alone.
She's not alone. A lot of people are saying, why are we doing dots? Why are we sort of connected? What are we doing here? The idea is, are they trapped by their own projections of where the rate cutting cycle will go? Is that a problem at a time where, talk about, I mean, this is sort of all of us.
In the air. Are we sufficiently restrictive?
Exactly.
Yep.
And so this really, to me, is... I want to see how they message that, given the uncertainty and given that some people are looking to them for certainty at a time where they cannot provide it.
How confident is the chairman of the Federal Reserve? That news conference just a day away.
The Fed is at the risk of losing confidence. They opened the door for the conversation of rate reductions too soon.
There's more inertia to inflation in a post-COVID economy than the Fed's giving credit for.
Rate cuts are being pushed back for the right reasons, but they're still coming.
The challenge has been everyone's waiting for certainty. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like.
The Fed would really like a scrap of certainty about what they're going to do later this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now from number 1 Bryant Park, Bank of America's home here in Midtown Manhattan. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market a little bit softer. If I could maybe capture the last 2 hours on this program in a word, bullish. Is bullish the word?
I don't know if it's enough. It's quite bullish. It's bully bull. Like, it's really quite optimistic. And to me, really, the ultimate question is, A, does this really challenge the idea of sufficiently restrictive? And B, can it continue? What's going to drive the next leg if it isn't going to be, say, NVIDIA, which we saw yesterday, somehow that was a dud, even though they announced a chip that would cost twice as much as the current chip?
Well, let's go through this piece by piece and talk about what it could mean for the bond market and go back to the conversation we had with Mark Urbana of Bank of America a little bit earlier this morning. What the bond market is telling you and what the equity market is screaming. This equity market so far this year is screaming really strong nominal GDP. Something Neil Dutter of Renmac talked about just yesterday when we were echoing some of his sentiments. If you look at what's happening in the bond market, we've repriced at the front end, 4.1 to 4.7, just like that in a couple of months. This equity market's done nothing in the face of that. It feels like the stock market so far, at least, and this is not a call of mine, just an observation about where we've been and where we are, seems comfortable with rates repricing higher.
And some people would argue, well, this is the reason why you've seen an underperformance in small caps. This is the reason why you've seen an underperformance in certain utilities or certain areas that are more interest rate sensitive. But the bottom line is, we're not hearing that companies are having trouble borrowing. We're not hearing that that individuals are having issues on their balance sheet with 40% more cash in terms of their savings than they had in 2019. You put this together and it raises this question, what is the pain threshold for rates? Is it 4.5% on the 10-year? Is it 4.75? Is it 5? Is the Fed going to test that at a time where right now it doesn't seem like they can really have conviction that inflation is cooling as much as they'd like?
Can we go back to that stat? I think it's stat of the morning here at BofA. I just find it absolutely amazing. So this is the 6th time I've mentioned these numbers. Median value of savings and checking balances are more than 40% higher from 2019 across all income levels.
And they're not going down materially.
They're stable.
That, to me, is one of the biggest takeaways. We talk about depleting your savings. This was supposed to be happening. It's not. What else did she say? That actually the cash coming into people's balance sheets, the paychecks, even on lower income households, are increasing quite significantly because there's real income gains. You put this together, you start to wonder, where are the cracks? I'm not seeing them.
Policy. I think they're the worries. And policy, maybe not from the monetary policy makers, but from the policymakers elsewhere. When you listen to Brian Moynihan a little bit early this morning, the Bank of America CEO and chairman, if you missed that conversation, go back and have a little look. Pick out the part on mergers and acquisition. We're not seeing less M&A because there's worries about the economy. There's worries about the deal getting done. There's a conversation there whereby a client can't even entertain the prospect of doing the deal, not because they think it's bad business, but because they are worried about being left hung out to dry for 12 months trying to work out whether it's going to be approved, and they don't want to be in that position.
Take that a step further. How much are we living in an era of fiscal dominance and fiscal policy dominance also, just with respect to what's allowed and the money that's gone into balance sheets? How much is the Fed kind of trying to fight against a fiscal dominance that just is all-encompassing? And if that's the era we're in, it has been understated by a lot of people to really fully embrace what that means and how much cash is going into the economy.
Big time. Got to find some time as well to go through this Bank of America Fund Manager Survey, because this is pretty bullish stuff, isn't it? Global growth expectations, 2-year high. Risk appetite, the highest since November 21. EPS optimism, 2-year high. Just optimism, optimism, optimism across the board.
But not euphoria, we heard. So it's all okay.
We're going to hear that word in a moment.
Exactly. So I want to know, what counts as euphoria? Please define euphoria.
We'll get to that conversation in just a moment. Let's start with the price action. Equities negative by 0.4% on the S&P 500. Just a little bit softer in the equity market here, Lisa. You look at the bond market, stable this morning at least, but a big move higher over the last week. We're getting back into the 430s all over again.
Yeah, some of the highs that we've seen of the year, which raises a question, what is that threshold again that becomes a pain point? Because right now, stocks have chugged along despite that, and the only kind of hiccups have come with buy the rumor, sell the news, the leather jacket, the godfather of the AI industry.
Jensen.
Woodstock, AI, blah, blah, blah.
It's the new roll neck, right? It's the new leather jacket.
Exactly. It's the new...
NVIDIA
yeah.
has replaced
The
Apple. Yeah.
Black turtleneck.
Yeah.
I like that.
You call it a turtleneck, a roll neck?
I never
Whatever.
heard roll neck.
Whatever. Coming up. Is that British? I don't even know anymore. I've been here so long. Okay. Next 60 minutes looks something like this. Savita Subramaniam, Jill Carey-Hall in just a moment on why they think markets and this market rally will broaden beyond big tech. And we'll talk about that word euphoria as well. Mike Gapin and Aditya Bahav looking ahead to tomorrow's Fed decision, and Lindsay Hart of Merrill Wealth Management on why clients are staying mindful of geopolitical risk. We begin with our top story. Tech giants leading stocks higher once again thanks to AI euphoria. Bank of America's Savita Subramaniam, head of US equity strategy, and Jill Carey-Hall, the head of US small and mid-cap strategy, saying this: we raise our S&P 500 year-end price target of 5,400 from 5K, but our bullish conviction has cooled since publishing our 24 outlook in November. We expect the market to broaden beyond the Mag 7 and pockets of the market where we have seen more euphoria. The net message of our market timing framework is still, in one word, up. Savita and Jill join us now for more. Thank you very much for being with us.
Thanks for having us.
Thank
this
you
is
for
very
having us.
exciting. I think this is our first time on TV together, so I'm very excited.
Well, let's talk about the constructiveness you both share. And Savita, let's begin with you. That word euphoria.
Yeah.
Where are you seeing euphoria right now?
Look,
and where aren't you seeing it?
I think euphoria is really driven by themes at this point. So it's AI. Everybody owns the AI plays. If you look at positioning, there's a lot of building euphoria around drug discovery, GLP-1. So there's thematic euphoria. But if you look at the actual allocation of fund managers, pension funds are at the lowest level of equity exposure, public equity exposure, that we've seen since the 90s. This is not a market like 99 where everybody is telling you to back up the truck on all equities. They're saying back up the truck on a few equities, mega cap tech, some pharma, but there's no broad spread euphoria in my view. And when you look at the positioning, it says something a little bit different than the survey data, which I think is also important. What they say versus what they do is sometimes very different. I think the risks are sitting outside of the public market. Look at where this credit cycle actually unfolded. It was in private credit, private equity. And I think those are the areas. Regional banks, I think, are still working out some of their problems, and Jill can speak to that as well. But I think that's where you're seeing the credit issues really bubble up.
Jill, let's turn to the banks. How concerned should we be? It feels like we've moved beyond what happened last year. Is that still a focus for you?
Yeah, certainly. I think the regional banks are still an area where I think it makes sense to be very selective. We're positive on small caps this year, but within financials, that's an area where larger banks have looked a bit better than smaller banks, but I think there's still opportunity in some of the regions. I think this is a market where stock picking makes sense. Our analysts have done a lot of work here. I think the environment this year has gotten a bit more optimistic for banks, given everyone was expecting a recession going into this year, and now we're not expecting a recession. Our economists will talk about that. I think the backdrop for M&A could pick up if we see, potentially an easier regulatory environment. We'll see how the election goes. And I think commercial real estate is still an issue, but it makes sense to, again, be selective, be a stock picker this year. And that's an environment where there's a lot of alpha opportunity.
To Savita's point, Jill, does that mean it's all priced in, all of those credit issues that we basically have heard?
I don't think it's all priced in. I think in pockets of the market, especially when you look at the broader backdrop within, small caps, credit sensitivity, refinancing risk, there's a lot of issues that if rates continue to move higher or stay high, these are areas that are a lot more credit sensitive, and we could see areas like real estate that maybe multiples haven't moved as much. For the overall market, I think for small caps, they have largely priced in some of the credit risks. They were pricing in a recession. They were pricing in, a manufacturing recession. They were pricing in tighter credit standards. I think we're in a backdrop where if these continue to ease, then there's a lot more upside in that segment of the market.
Which is the reason why, Savita, it's so fascinating to hear you talk about how it's not a back the truck up kind of moment like it was in 1999 for all stocks, just some stocks.
Some stocks.
But it sounds like you might want to keep backing up the truck in those stocks because they're not as susceptible to rates remaining high. Well, they're not as susceptible to people getting cold feet and realizing that, oh, yeah, there is some weakness in certain pockets.
Yeah, no, I think it's fair. And look, I see large caps as safer until we start to see the Fed really cut interest rates, because where we are now is an environment where we're pricing in, what is it now, three or four rate cut hikes?
2 or 3 now.
3 rate cuts this year. And if we don't get them, I think that's the risk for some of these more credit-sensitive areas like real estate, like, small caps writ large. I still think there's a lot of smaller companies that are economically sensitive that could do well in this environment. And then the thing I like about the S&P 500 is that a lot of the really risky stuff drifted down in market cap. So you're starting to see the S&P almost get higher quality by attrition since 2022 when the Fed started cutting rates. So if you look at CRE exposure, commercial real estate exposure of the large cap banks, it's a tiny sliver versus where we see it elsewhere. When I think about what you were saying earlier about, this policy having given the private sector, consumers and corporates, a long runway of making money on their short duration asset base and locking in long duration liabilities, I think that is what we're seeing in the S&P 500, in the average U.S. consumer. And those are the areas where I think we can press this, because even if the Fed doesn't cut interest rates, there's still, relative health and relative gains in those cohorts.
That's what I wanted to get into. Why do you think we have been so comfortable with this repricing of interest rates higher? Why do you think we've been so comfortable with hot CPI prints, hot PPI prints? Last week, CPI came in hot. The equity market rallied.
Yes.
What's that about?
Well, the S&P rallied, and parts of the S&P rallied because I think that the S&P 500 is now, a different animal than what it was in 2007. Half of it is asset light. It's got positive net cash in the biggest sectors of tech. So I think it's a very different credit cycle. And this is what we need to pay attention to is where has credit been extended, who borrowed, and who's going to be hurt by a rising interest rate cycle. We're starting to see that, but I think that's what unfolds over the next few years.
Leadership has been narrow. I think we can all agree on that, particularly last year. You make the point, Jill, and I think it's a point worth exploring, that small caps tend to outperform following periods of narrow leadership. What is that about? Is that connected to the cycle? What is that trend?
Well, I think, we've seen it both small caps tend to outperform and as Savita, and we expect, the equal weighted S&P 500, we see opportunities there as well. I think, we're in an environment where the market was led by these very narrow themes, some of these mega cap growth stocks. And now you're at a point where positioning is starting to turn more positive on economically sensitive themes. We've seen inflows into small caps for the last several months, but positioning is very light. A lot of these things run in cycles. So small versus large cap leadership, these longer cycles tend to last about 10 years. Investors were in a period from 2013 to 2020 when small caps underperformed. And now the average multi-cap manager is about 40% underweight small caps in their portfolio. So, I think this is a point where you're starting to see more interest in the theme. The economic data, some of the macro indicators that Candace talked about earlier are all turning off the bottom. So that tends to be a positive environment for some of these areas of the market that your average fund manager is underexposed to, like small caps, like cyclicals.
It sounds pretty bullish. I mean, yes, there's some risks if the Fed does keep rates here.
I think it's meant to sound bullish. I think that's the objective.
I guess here's my question. It's not necessarily the same kind of conviction that you used to have. Why?
Well, I can answer that. I think for me, it's because there is more high conviction bullishness on equities. Like I said, not all equities, but pockets. And I think those are the areas you want to watch. I mean, how much do these AI plays have to beat earnings from here in order to continue to go up? So that's where I worry. And I really firmly believe we could see a correction in those areas of the market. We could see a 5% pullback in the S&P, which has been, the straight up benchmark for the last, almost 20 years now. But I think that those are the risks. I think outside of these themes, there's a lot of, dry powder for real growth. And when you listen to the Institute, when you listen to Candace talk about the indicators we all track, it sounds like this is more of a GDP story rather than just an earnings story.
Which raises this question, in a GDP story, don't bigger companies have an advantage structurally at a time where if they can invest in technology and they can invest in some of these small near-term investments, even as they lock in their longer-term obligations, Jill, ultimately don't you get smaller companies fundamentally disadvantaged in a new way that's different from in the past?
Well, I think while there's some of that, I also think that if we're in a CapEx cycle, a lot of the domestic smaller companies are the ones that benefit if, a large mega cap is spending. The domestic SMID cap, especially if some of these companies are reshoring, bringing back manufacturing to the U.S., I think that's a longer-term theme that'll benefit some of these cyclical domestic smaller companies within the U.S.
Final question, Savita. We often do this. I always ask you this. Biggest risk, still upside risk?
To the S&P?
Yeah.
Yeah, I would say so.
Savita, great to see you. Jill, thank you to both of you. I can't believe you've never done this together
I
before.
know.
But it worked beautifully.
Thanks for coming.
Thank you very much. Thanks for having us. Up next on this program, NVIDIA looking to extend its AI dominance.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today.
That conversation up next, live from New York City. This is Bloomberg. Live from New York, the opening about 1 hour and about 12 minutes away. Your stock market looks like this on the S&P 500. Equity futures through most of this morning negative, still down by 0.5%. Yields just about unchanged. 10-year, 4.3223. Under surveillance this morning, NVIDIA looking to extend its AI dominance.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
Here's the latest this morning. NVIDIA unveiling a new AI processor design called Blackwell. The CEO promising it will be industry-changing technology. Alkesh Shah of Bank of America Global Research weighing in on the AI craze, writing, quote, "It represents a paradigm shift in line with past disruptive technologies. However, significant economic implications do not necessarily indicate immediate top and bottom line growth for the enterprise software companies producing AI products." Alkesh, I'm pleased to say, joins us around the table. Alkesh, good morning to you, sir.
Good morning.
Thanks for having us. So I'm going to go full doomsday, sort of end of history type stuff. We all end up on UBI, the end of aspiration, incredibly depressing. Where is this going? Is it going to be capitalism eating itself, or does it end up being something much better than the world I've just described?
Sure. So, well, first, thanks for including me.
You don't have to thank me for that.
I was about to say. Good morning.
So if we take a step back, really the way we're looking at how AI changes virtually everything we do is it's probably the third transformational wave that we're experiencing. The first one was actually the microprocessor in the 70s. So what that did was it democratized access to computing power, right? Everybody got a PC, they have a notebook, you now have a smartphone. Then in the 90s, you democratized access through the internet browser to information. So in the 70s, democratized access to computing power. In the 90s, democratized access to information. And even though AI is about 70 years old, really the Gen AI technology has democratized access to intelligence. So that's the real change. So now that you have access that only data scientists and quants used to have, you actually can use intelligence straight from your smartphone, leveraging all of those waves. And that's why we think, really, we're only in 1995 of this build out. So, as somebody who covered parts of the internet back in the 90s, I've watched those cycles, and there are definite parallels with the build out. And we're only 15 months into this build out, as my colleague Vivek, who covers NVIDIA, has talked about, and it will be years, because there are different stages for that.
So we've got to identify winners at different stages. And as you know, through the internet, if it's 95, identifying who the ultimate winners would be in that period was actually difficult. So you just bought everything. And a lot of people bought the wrong things. What do you do now? What's the best approach? How do you think about who wins each stage of each cycle?
Sure. So if you think about the stack of technology for AI, the first thing that you have to do is you actually have to build these models so that you can leverage the AI having applications on top. So that's what you're seeing right now. You're seeing the chips, the servers, those are being bought and those are being deployed. And at this point, the models are still growing. So that build out is still happening because the applications that we want to use on top of them aren't where we want yet, right? The average intelligence is probably of a 15-year-old intern. And, it's great to have an infinite number of 15-year-old interns, but but you definitely, want something more intelligent over time. So you still need more processing power. You need to upgrade those models. And those models, though, are benefiting the chip companies, the server companies, as my colleagues Vivek and Wamsi talked about, but also the public cloud companies where those models are sitting, right? And so that's why we like Microsoft. That's why my colleague who covers the internet likes Amazon, likes Alphabet, because those guys are benefiting because they're actually hosting those models. And that's very different from the internet, right? Because in the 90s, the internet was built using debt. Right, all of those telecom companies raised all of this debt, and the companies that were doing applications on top of that had no monetization models. When that stopped, those companies went bankrupt. What's different here is these models are being built out of cash flow of the public companies, not debt, and the private companies are using equity.
I love this. John asks, are we facing the end of times? You say we've democratized access to intelligence. I mean, this is basically where we're at. Here, I just want to know, to put a bow on all of this, there is a belief that some of the broadening out in the equity rally is going to stem from productivity gains tied to artificial intelligence. Are you essentially saying it is too soon? It is going to take years before we see it percolating out to the rest of industries? Or are you possibly seeing the democratized access to intelligence making our world better?
I think over time it will make our world better. I think the expectations were that things would get better immediately, which it will take time, right? Because what has to happen is corporate adoption needs to take a deliberate approach because they have to understand the models. If you're a regulated industry, you have to explain the biases within the models before you can really use them, before you can roll them out. So it will take a few years, but what we did was, we have the #1 research team on the street. I surveyed our analysts to figure out exactly what they thought their sector would benefit from AI over the next 3 years. And on average, we expect a 250 basis point operating margin improvement, which is $65 billion annualized savings for the S&P 500, over $100 billion of savings a year.
Wow.
Globally. And that could be conservative because that was a survey that was done a few months ago without all of the applications that are coming out now. So we definitely see it hitting over the next 3 years. So it won't be a straight line up, but we definitely see the line moving up.
This is far less depressing than my commentary, Alkesh, you realise that. Look, the way I think about it, and it's problematic, is that better for who is how I'm thinking about it. Brian sat in your seat just a moment ago and we were talking about how less labour intensive each additional dollar of revenue is. Now, if that's the same for all these companies that adopt this technology, it's going to be a lot of people without jobs, Lisa.
Well, and take it a step further, the people that they do have are paid a lot more because the actual workers who are able to meet the challenge at hand, who are smarter than a 15-year-old intern, are able to get paid accordingly while other people are going to struggle to be employed. I mean, that's sort of the dichotomy that we're talking about.
I'm going to give you a call because we need to have a longer conversation. Super smart. Thank you, sir.
Yep,
Alkesh Shah there on AI, beyond just sort of the depressing end of history type stuff. And,
You're the only one pushing that.
Actually, I don't think I'm alone. I got a lot of people reach out to me
A lot of people, I would agree.
Who share that
some
concern.
family members.
Yeah. Ready?
Mm-hmm.
Yeah. Oh, yeah. I know you told me. Coming up, breaking housing data and building permits. Bank of America's Mike Gapin and Aditya Bahaf here to react and give their outlook for the economy and the Federal Reserve tomorrow. The last slate of economic data going into the Federal Reserve tomorrow. Some housing starts and building permits coming up in just a moment. Mike McKee's going to break them down for you. Let's start with some price action going into that. Equity futures on the S&P, on the Nasdaq, on a Russell. We're negative across the board. Those losses are building up in the last 10, 15 minutes or so. We're negative 0.5% on the S&P, down 0.8 on the Nasdaq. In the bond market, switch up the board, a 2-year yield higher over the last week or so. 472, a little bit lower this morning, down a basis point at the front end of the curve. With that economic data, let's cross over to Mike McKee. Morning, Mike.
Good morning, John. Well, we were expecting a rebound in housing starts, and we definitely got one. Weather improves in February, and so do the number of holes in the ground. 10.7% increase to a 1,521,000 annual rate for housing starts. Building permits also up significantly, 1.9% to 1,518,000. That's from a decline of 0.3 the prior month. So it looks like home builders are gearing up for the spring selling season. This is one of those interesting numbers that we expect to keep going up because there's not enough houses for sale. So it's not so much that, it's when do we get more housing for sale from the existing home markets. I know you've got some smarter economists than I there that you can talk to about it, because it's all a question of interest rates at this point.
Well, Mike, it's sort of an upside-down world. Rates have gone up to 5.5%, but supply's been constrained and prices have gone higher. Mike, can you make sense of some of this for us?
Well, that's one of the problems that the Fed faces, is that normally they would affect housing. They would bring housing down, and people would sit and wait, and then when they cut rates, people would go out and buy houses again, and then prices would rise. In this case, because so many people locked into very low rates, prices are rising because there's nothing on the market to buy, and the Fed is not being able to have the same kind of influence it has on interest rate sensitive sector of the economy, the biggest one.
Mike, I'm really struck by the fact that, yes, we did see a rebound, but it was even bigger than people had previously expected, right? And this has been sort of the theme that we keep getting, that instead of being 1.4 million, it was 1.52 million. I just wondering, when you take a look at this, what that suggests to you about how economists continue to underball or lowball some of the growth and some of the desire to keep building and expanding.
Well, it all depends on what numbers you look at. The ISM numbers, for example, suggest that we're seeing some manufacturing business slow down. The thing about housing is there is a big built-in demand. A lot of people want to buy houses, and there's not enough houses for sale. What these numbers may suggest is that the supply chains for building materials have gotten a lot better, and that builders are able to find workers, construction workers, to follow through on their building permits. So this is one category, the new home construction area, where things have been a little bit better than have been expected.
Hey, Mike, we've got to leave it there. Looking ahead to the Federal Reserve, Mike McKee and the latest economic data. Equity futures on the S&P, we're about an hour out from the opening bell. We're negative here by 0.5%. Joining us around the table, Michael Gapin, the Bank of America Global Research Head of US Economics, alongside his colleague, Aditya Bahaf, Senior US Economist. Mike, Aditya, great to see you both.
Thanks for coming to One Bryant Park.
Thank you very much for having us. Thank you once again. Before we get to the Federal Reserve, can we just talk about the recent economic data? And can you point to something that demonstrates we are sufficiently restrictive at the Federal Reserve?
It's tough. I mean, as Mike was just saying, housing is your typical suspect, and it's hard to... Housing did react. Activity did slow down, but maybe not for the reasons one would expect. I think you could point to bank loan growth as another area that's responded to higher rates. But outside of maybe loan growth and housing, it's difficult, in my view, to find sectors of the economy that had obvious interest rate effects.
Aditya, are the long and variable lags just super long, or are we just not tight enough?
Well, we are starting to see some impact on retail sales as well. The last couple of prints have been soft, and then what was more notable for me was the downward revisions. So after those revisions, it really looks like about 4 of the last 5 months on retail sales were somewhat weak. So we're seeing some moderation there. So far, it's being offset by very strong services consumption, but we'll have to see if that continues.
All right, I have to say, we've spoken to one person after another. Everyone's been bullish this morning. Looking at the consumer, yeah, retail sales might have been a little bit softer, but for the most part, right, it was, cash really good. Then the economists come in, and you guys say, well, there's a little bit of weakness. Is that enough, Aditya, that sort of we had one bad retail sales print, that otherwise people are being more discretionary? Does that really suggest we're sufficiently restrictive?
It's a good question. I think it's, as Mike said, it's tough. It's a question of supply and demand. Right, what we experienced in 2023 was a very broad supply shock from the labor market, from supply chains healing, and just by definition, when you get a positive supply shock, you're going to get above trend growth and disinflation at the same time. right? The question is, where do we stand on that? And if those supply shocks go away, then I think we'll get a clearer picture of what's happening with demand under the hood. Some of the work we've done suggests that demand is cooling off a little bit, but there's more ways to go.
Is this enough, Mike, to give the Fed confidence that there's some kind of true disinflationary trend other than just year-over-year comps that were nice for a couple of months?
Yeah, I think that the premise to your question, I think, is saying is, does the Fed actually need to do more to bring inflation down, or is supply enough, right? So in other words, is it, do we need restrictive policy to get sustainably to 2%? Because I think most people would say policy is moderately restrictive. It's doing something, but there's a question how much. But they're complementing that by saying, well, we're getting this helpful boost in supply, and that's also what's bringing inflation down. The combination of the two, I think, gives them confidence about the overall disinflation trend. So rates at some point should move lower. The lack of confidence is about when does the window open, when does the data tell them, okay, it's fine to start. So I think there's a little uncertainty about when to start, but I think the confidence in the overall disinflation trend is there.
So your call now is June. So let's talk about June. What is special about June, apart from the fact it's not March? What is special about that month? Why is that the month now for so many people on Wall Street?
I'd say two reasons. The data aligns a little better in June in terms of year-on-year rates of inflation being, we think, at subjective levels that they might like. Are they about to move the
goalpost here, though, Mike? Are they going to focus on year-over-year and not the month-over-month surprises?
Year-over-year is kind of, they've said we had a good 6-month run, we need more evidence. So I think that's kind of shifted us all to looking more a little to year-on-year. The other reason I would say June as opposed to May or July is that if you think you're cutting rates every other meeting once you start, I think you want to align those policy decisions on meetings where you release new projections. So I think that puts all of us on June as opposed to, say, May or July.
Let's build on that word confidence. The chairman talked about needing more confidence. Do you think, based on the evidence that we've seen, the data we've had between the last meeting and the one we're about to see tomorrow, that this chairman has lost, gained, or retained confidence?
I would say less confidence around the timing, but still confidence on the overall disinflationary trend.
You could sense Aditya in that news conference the last time around. He wasn't quite comfortable talking about the overall disinflationary trend. Yep. And he wanted to know whether any of it was due to one-off factors. When you look at the trend for goods inflation, do you think maybe that worry is justified?
So we got 1 month of goods inflation after several months of outright deflation, so I wouldn't say that's a concern yet. There's a couple of things, if you want to be concerned, that you could be concerned about.
One of them is...
Okay, well then let's give you something to be concerned about, right? One of the things is there was this question, if you just do it from a bottom-up perspective, about whether goods deflation would end or slow down before housing started to cool off. And it looks like that might be the case. Again, it's 1 month of data. You don't want to take it too seriously. But that suggests that you could get stuck above 2% for a longer period of time. That being said, the other concern out of the January report was that there was this big jump in services ex housing, right? Would that continue, or was that a one-off? And that actually looks like it was more of a one-off.
There is also this question that we keep raising again and again. Are financial conditions contributing to a prolonged inflation, kind of sticking in the economy? And Michael, I'd ask this of you. Do you think it's important for the Fed to push back a little bit and say, yeah, if things get this easy, if anyone can borrow, if stock markets are doing great, if you see mortgages start to come back to the fore, if you just get a 0.5 percentage point drop in the rate, do they need to do that to kind of bring this sort of a little bit more in check?
I think they need to keep financial conditions restrictive. I do. I think things rallied too much from their perspective from the October-November period to earlier this year. I think they know if we're going to start an easing cycle at some point, financial conditions are going to ease, right? So they can't, have their cake and eat it too. But I do think they need to keep financial conditions restrictive on average. And I think they are. I think by our proprietary indicators, they're restrictive, but they're not as restrictive as they were in prior cycle peaks. But again, if they're getting a supply side rebound, that should be enough. But I think to your point, they would want to lean against, in their mind, whatever is excessive easing in financial conditions.
Aditya, how is this restrictive?
That's a good question.
Get all the hard questions.
Right, right. So what I would say is the Fed would be way more concerned if the markets aren't pricing an amount of cuts that the Fed views as appropriate, right? That was the case earlier this year, at the start of the year, when the markets were pricing 6.5 cuts, and that was clearly not what the Fed had in mind. Once the market's pricing a sort of reasonable number of cuts, let's say 3 this year, or 2.5, then whatever that implies for equities, spreads, I don't think they want to get involved in that, right? They don't want to be in the business of managing risk premia. So I think they're reasonably comfortable now. They probably weren't at the start of the year, which is why the pushback was a lot more aggressive at the start of the year.
Let's finish on the playbook for tomorrow. So statement, projections, news conference. Let's go to the second point, projections. Only takes a few policymakers to come up just a little bit. That median drop's going from 3 to 2. Aditya, is that what you're expecting tomorrow?
No, we're expecting them to stay at 3 cuts, the median 2, but it's a very close call. As you said, it only takes 2 people to move up in order for the Fed to go from 3 to 2 cuts. The question is, do you really want to signal that? What are the implications of that? Just to add to a point that Mike was making earlier, if you can't justify a cut by June, given that the base effects will be a lot less favorable for the rest of the year, you might not have a leg to stand on to start cutting until early next year. So that might be a reason to just get going now unless you're really comfortable starting next March, right? So for all of those reasons, we think it stays at 3, but it's going to be a very close call, and that's going to be the big focus for markets.
Mike, what would you look for?
So we're on the same page for that. But yeah, it's a close call. I think you're going to get a big upward revision in growth, something maybe to around 1.8 this year. We think PCE inflation on a core basis gets revised to 2.5, 2.6. We're at 2.6. We think there's enough time between now and June for them to say, let's look at the data a little bit more and not prejudge it. But yeah, it's a close call.
Can I just say, they don't care about spreads and micromanaging them when they're doing well, but they care when they're doing badly. So it raises this question, ultimately, we're talking about a Fed put all over again,
Do you want them to be consistent? Is that what you're asking for?
I'm just looking for some sort of
I think we're trying to figure out how
policy.
symmetrical this actually is right
Thank
now.
you.
I think there is a belief in the market, there is an asymmetric stance at the Federal Reserve that if growth is strong, they won't respond to it with hikes. If it's weak, they can cut. I think what we're trying to figure out, at least from myself over the last week or so, with hotter than expected inflation prints, whether that tempers their ability to retain that option of just saying, we'll cut if the economy weakens, we won't hike if it gets stronger.
Right. And I would add on top of that asymmetry, remember in average inflation targeting, you're only responding to shortfalls of employment from its maximum level. So another reason to kind of ignore what's happening on the activity side.
And just on that subject, we get asked a bit about the downside risk, right? And I think the big downside risk is probably if you can't cut this year, you get to next year, inflation's still sticky, things slow down and you don't have the Fed put, right? So we've been so reliant on the Fed put that the big downside risk to the economy is if that goes away, things could get sticky.
What do you think they would do, Mike? Can we finish on that? I want to give you the final word. If the dual mandate went into conflict, how this Federal Reserve, led by Chairman Powell, would handle it? How do you think it would handle it?
So in what sense would it be in conflict?
In conflict, if inflation was still above target, but unemployment started rising and it threatened maximum employment?
Ultimately, I think they'd respond to the activity side, because I think you would assume inflation with a lag would ultimately respond to that economic
Would that be the right assumption?
Yes, I think so.
Okay.
Yeah.
Mike, appreciate it. Michael Capon.
Kind of a weak last word there, but thank you.
No. Don't worry. The conversation will continue from Bank of America to the two of you. Thank you. Looking for that median dot to maybe stay at 3 with a threat, Lisa, of dropping to 2. And it wouldn't take much for it to go from 3 to 2 tomorrow.
It just raises this interesting question, is inflation a lagging indicator? And is sort of the jobs market a leading indicator? And is that really how they're going to respond? Are we looking at sort of an implicit 3% target rather than 2?
I think the meeting tomorrow is a little bit more interesting than it was maybe a month or so ago.
I would agree.
That's what I'm going with.
We're going to talk that up.
Let's get you an update on stories elsewhere this morning. Is that marketing? Is that what that is? Promo
Watch
for
our
tomorrow's
Fed show.
Special. Let's get you the Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. Hong Kong has a fast-track measure further cementing China's control over the global financial hub. The approval of Article 23 completes a 2-decade campaign to pass local legislation protecting the Chinese state. New crimes such as treason and insurrection carry life sentences, and the measure also broadly defines state-secret offenses in line with China's vague legislation around espionage. The move raises questions over the city's status as as an investment and tourist destination. And Bitcoin continues its slide from an all-time high after record daily outflow from the world's biggest ETF for the token. The $25 billion Grayscale Bitcoin Trust posted a $643 million outflow just yesterday, the most since the ETF began trading on January 11th. ETFs overall have attracted a net $12 billion, which helped propel Bitcoin to a peak of nearly $74,000. Philippines President Ferdinand Marcos Jr. said the threat to his nation from China's sweeping claims in the South China Sea is growing, but argued that his government's effort to assert sovereignty over disputed areas are not meant to start a conflict by poking the bear. Marcos spoke exclusively with Bloomberg's Haslinda Amin a few hours before the U.S. Secretary of State Antony Blinken.
It does not serve any purpose to heighten tensions. That is precisely what we want to avoid. This is not poking the bear, as it were. We are trying to do quite the opposite. Yeah.
And that's your Bloomberg Brief, John.
Hey, Shanali, appreciate it. Thank you. Up next on this program, the recession that never arrived.
Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not.
That conversation up next, live from New York City. This is Bloomberg. The opening about 42 minutes away. Here's the state of play, the scores, if you will, on the S&P 500. Equity futures negative through most of this morning. A little bit negative now by 0.4% on the S&P 500. Unlike the last week or so, yields a little bit lower on the session, on the week a whole lot higher. 431 on a 10-year at the moment. Dollar strength has been a theme in G10 over the last 24 hours against the euro and the Japanese yen. Lisa, euro dollar 108.55.
Really, it's going to be the emphasis on Jay Powell and whether he comes out with a bit of a hawkish tone. Does he push back against some of the enthusiasm we've seen in markets? Are there 2 DATs rather than 3? This, to me, is going to be the main macro driver when it comes to FX potential volatility, which this year has not been great.
And the enthusiasm, by the way, enthusiasm in this building over the last 3 hours. The constructive tone at Bank of America is pretty phenomenal, isn't it?
The stats that we've hooked onto, right? Not only the fund manager survey showing that enthusiasm, the cash, you can repeat it for a 7th time, 40%, more than 40% increase.
That's insane.
In the cash and savings that people have on their balance sheets. It's not going down. So why are people feeling like the consumer is running out of steam? It doesn't look like that when you look at the back.
This economy has been a whole lot stronger than many people expected. Under surveillance this morning, the recession that never arrived.
Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing the little bit of tension here. So everything's fine, solid, resilient, all the words you want it to. But it has to sort of work the next twist in the economy to get back to normal.
Here's the latest this morning. The Fed's 2-day meeting beginning today as the committee prepares its latest summary of economic projections. Bank of America's Merrill Wealth Management saying clients are, quote, feeling optimistic, but investors are mindful of geopolitical risks as they continue to keep a close eye on Fed announcements and anticipate some choppiness throughout the year. Joining us now, I'm pleased to say, Lindsay Hunt, the president and co-head of Merrill Wealth Management. Lindsay, good to see you.
Great to be here. Thank you for having us.
Thank you for having us.
Yes.
Let's start with these numbers coming out of your side of the business. 2023,
Yep.
You added a record 37K net new clients. That's up 50% versus the prior year. Where has that business come from?
Yeah, it's a great question. We've seen tremendous interest in clients working with financial advisors. We chalk that up to a couple things, John. We look at the pace of wealth creation in this country, which is accelerating. It's really doubled when you look at U.S. household financial assets for wealth management in the last 10 years. We don't see that slowing down. You see the wealth transfer, the great wealth transfer. It's not going to happen. It's happening now. And the world's becoming more complex, not less. So all that backdrop really leads to more and more clients realizing the value and the need for professional financial advice delivered by a human being. that's our FAs, that's our financial advisors.
Yeah, the human being aspect of that's important.
Yeah.
We might return to that a little bit later in the conversation. Can you talk to us about the nature of that money? Where's that money gone? Is it just sort of cash funds, people sitting there in money market funds taking 5% and sleeping well at night? What is it?
Good question. We've seen a shift. Prior to the fourth quarter of last year, we did see our cash balances really grow, really to a level that was 3 times prior to the current rate hike cycle. We started in the fourth quarter seeing that cash move off the sidelines. Where is it going? It's going into a couple different places. You see it moving into equities and fixed income. Our clients tend to move into our professionally managed portfolios, either by Chris Heisey and our CIO team, or all the separately managed accounts we offer on our platform to clients. So you see it going into equities. You see clients last year, especially in the back half of the year, lock in yields. We saw a lot of bond ladders. And then you're seeing alternative like investments as well. So we're seeing clients, and it's got to be a certain type of client, but you're seeing clients wanting access to private markets as well as public. And our AI assets have doubled in the past 5 years.
I just am wondering, just going back to where is the money coming from, is it all the same households that are just building their wealth and then able to come to you? Or is this actually a broadening net where people are earning more and able to invest a greater proportion of their assets?
I think it's both. There is a lot of wealth creation that still is happening. Businesses are continuing to be sold. Liquidity is being generated. Wealth is being transferred between generations. You look at baby boomers, which control half of the wealth. That's ages 59 to 77. That's an age demographic where money's not going to transfer. It's starting to transfer. It already is. So you're seeing all the above. And those are all the clients that we can serve.
The reason why I ask this is because I think about sort of this idea that consumers have locked in benchmark rates if they have mortgages, if they already have bought a house. They aren't paying that much more in interest, but they're earning much more, not only in interest from even short-term instruments, but also from an equity market that's doing just fine. So this is where it comes from, that easy financial conditions, that basically these are consumers that have much more spending capacity. How much is that sort of possible to continue? How much do you see that as like sort of something that has legs?
Listen, we still see a tremendous amount of cash on the sidelines. I think that's come up here earlier in the program. So that money is going to get put to work. We look at that money, like I said, as of the fourth quarter, we see that money moving into our fee-based platforms at a really high rate. We're on pace to well exceed last year what we saw. And look, it's really client by client. So in our business and wealth management, no client is created equal. Our financial advisors work with our clients, figure out liquidity needs, how much money do they have to have on the sidelines, how much money should they put to work, what's their risk tolerance, their time horizon, their comfort level with risk, what are their growth projections, and all that is done in a financial planning context. And most of our clients are asset allocated. Most of our clients have a well-diversified portfolio across equities, fixed income, some alternatives as well. And then cash has become an asset class again. So, there is a piece of your day-to-day operating cash, and there often is a piece where if we've got a little money, we can wait, we can earn pretty decent yields.
We've got about 30, 40 seconds left. You talked about adding people.
Yeah.
Music to our ears, not sort of robots and AI and tech, people. How important is that to you?
Yeah, 65 trillion is what we estimate U.S. wealth management assets. This is a business that is, we believe, best led by human beings. So you need more advisors to go up against that marketplace to complement the existing FAs we have today. And before you let me go, it's Women's History Month, so I'd be remiss if I didn't acknowledge that opportunity, both for our terrific women financial advisors that are here, that lead the industry, as well as talent that should absolutely come into this profession. We need more women to come here and face off against the market.
Led by you, and thank you very much for your time today.
Thank you for having us.
Thank you.
And on behalf of all of our colleagues, thank you for being here. We're so happy to host you, and we hope you come back.
Well, thank you. If you'll have us,
yes, we will. I'm not sure about everybody over here. We'll love the noise interruption.
I don't know if they want us back.
Yeah, but thank you so much.
Lindsay, thank you. Lindsay Hunt of Merrill Wealth Management. Just a programming note for tomorrow. Tomorrow, of course, Federal Reserve Decision Day. We'll be catching up with Francis Donald of Manulife, Wei Li of BlackRock, Steve Major of HSBC, Jan Hatzius of Goldman Sachs. Let's finish with this, Bramo. A special thank you to the whole team at Bank of America at One Bryant Park.
And all of their incredible bullishness to kick off Fed meeting.
Does that make you uncomfortable?
Of course it does, but come on. But no, we're basking in bullish.
Live from New York City, for our audience worldwide, this was Bloomberg Surveillance.